Good morning, everyone. My name is Alicia Lewis, and as the Market Risk Advisory Committee's designated federal officer, as well as its acting chair, it is my pleasure to call this meeting to order. Before we begin today's panels, I would like to turn to Commissioner Rustine Behnam, the MREC sponsor, to give welcome remarks. After Commissioner Behnam gives his remarks, we will have opening remarks starting with Chairman Giancarlo, then Commissioner Quintenz, and then Commissioner Behnam.
Thanks, Alicia. Good morning to everyone. Welcome. Welcome to the folks in the audience, of course, those on the webcast, and most importantly, the members of the MREC. It means a lot to me, and I know Chairman Giancarlo and Commissioner Quintenz that you're here today. It certainly is a long day, and many of you traveled from outside of the district, so it means a lot to us in the commission, and we're looking forward to a good, healthy conversation. Before we get started with the formal remarks, I do want to take a quick minute to thank CFTC staff. For many of you, you know this room is not typically set up like this, and it's a lot of work that goes into setting up the room, both for the AV internally and externally for the webcast, so I do want to take a moment to thank them for all of their work. So with that, thanks again for everyone for being here, and appreciate all of your work, and looking forward to a good conversation today. Thank you.
Thank you, Commissioner Behnam. And now we'll have opening remarks. Chairman Giancarlo?
Thank you, Alicia. Good morning, everybody. A warm welcome to all the MREC members, those who are here, and to other participants and those who are on the telephone. It's good to have you. And I must say, it is really good. This is the first public meeting of the new commission, and it's great to be seated here with my two fellow commissioners, Commissioner Behnam and Commissioner Quintenz. Hopefully, the three of us will have company up at this dais sometime this year. Today, we'll continue the CFTC's history of thoughtful and thought-provoking advisory committee hearings under this new commission. We had hoped, as you know, to kick off that continuation last week with a TAC committee meeting, but unfortunately that meeting had to be rescheduled. Nevertheless, Commissioner Quintenz, Dan Gorfine, and the TAC members have done a lot of preparation, so it's going to be a great program when it takes place on February 14th, which is Valentine's Day, so please don't miss it. And our other advisory committees, Ag, Energy, and the Global Markets, will also have scheduled meetings in the months to come. But today, we kick off the year with MREC. And as you know, this committee was very active and very effective under former Commissioner Sharon Bowen. No doubt such good work will continue under Commissioner Behnam, designated federal officer Alicia Lewis, and the MREC committee members that are gathered here today. Today, the committee will discuss the product self-certification process under Part 40 of the Commission's regulations, and it's an excellent program. 2 weeks ago, I had the honor to speak at the annual conference of the ABA section on derivatives and futures law. I discussed derivatives on virtual currencies and the appropriateness of requirements under CFTC regulations for the review of such products. I spoke about the review and compliance checklist that the CFTC staff deploys to ensure that self-certified virtual currency futures products and their cash settlement processes are not readily susceptible to manipulation, and that virtual currency derivative products are sufficiently margined. And I also said that I was neither an apologist nor an opponent of the current process of self-certification. Rather, I and my fellow commissioners are inheritors of that process. And we're not the first commission to have a conversation about the right balance of interests for the self-certification process. That's a conversation that's predated virtual currencies. But I also said that it's quite clear that Congress and prior commissions designed the product self-certification framework to give the DCMs, in their role as SRO, self-regulatory organizations, the ability to design and certify new products. Congress deliberately framed the self-certification process so that development of derivatives products would not be stalled by regulators wary of the political risks of approving new products. And I went on to say that the CFTC's current product self-certification framework is generally consistent with public policy that encourages market-driven innovation that has made America's listed futures markets the envy of the world. Well, a week after that ABA conference, I met in Washington with a senior European markets regulator to discuss a range of different topics. Unprompted, he brought up the CFTC's self-certification process, and he said that he thought it was the reason why most new financial products originated here in the United States. In fact, he had a point. According to CFTC.gov, less than 800 futures products were approved by the CFTC prior to self-certification. And since then, U.S. exchanges have self-certified over 10,000 new products, far more than in any overseas marketplace. It struck me that sometimes it helps to be reminded of our advantages by our foreign competitors. Now, that's not to say, however, that existing review processes should not be assessed and, where appropriate, improved. At the ABA conference, I noted criticism from some market participants that the CFTC did not hold public hearings prior to self-certification of Bitcoin futures. I pointed out that unlike provisions in the Commodity Exchange Act and Commission regulations that provide for public comment on rule self-certifications, there is no provision in the CEA or regulations for public input into CFTC staff review of product self-certifications. It's hard to believe that Congress was not deliberate in making that distinction. In fact, it is the DCMs and DCOs, and not the CFTC staff, that must solicit and address stakeholder concerns in new product self-certifications. Interested parties, especially clearing members, should indeed have an opportunity to raise appropriate concerns for consideration by regulated platforms proposing virtual currency derivatives and DCOs considering clearing new virtual currency products. That is why I've asked the CFTC staff to add an additional element to its review and compliance checklist for virtual currency product self-certifications. That is, requiring DCMs and CEFs to disclose to CFTC staff what steps they have taken in their capacity as self-regulatory organizations to gather and accommodate appropriate input from concerned parties, including trading firms and FCMs. Further, I've asked the staff to take a close look at DCO governance around the clearing of new virtual currency products and formulate recommendations for possible further action. In closing, I believe the issues raised by self-certification of virtual currencies are the degree of responsibility of DCMs under the CEA and Commission regulations to ensure that virtual currency derivatives are not readily susceptible to manipulation, and the degree of responsibility of DCOs under the CEA and regulations to ensure that virtual currency derivatives are sufficiently margined. I look forward to today's discussion of these important issues. It's timely. We see what's on the horizon, and we must be prepared and be responsible. As we confront the challenges ahead, we will look to the thoughtful deliberations of advisory committees like this one today. I thank again Commissioner Benham for organizing this meeting along with Federal Officer Alicia Lewis, and I thank all of you for attending and participating. Thank you very much.
Thank you, Chairman Giancarlo. Commissioner Quintez?
Thank you very much. Thank you, Commissioner Benham, for your leadership of this advisory committee and for convening today's meeting, and Alicia for your very hard work in organizing. I look forward to a very thoughtful discussion today on the process by which exchanges may list contracts for new or novel products and the CFTC's role in that process. And let me just say that I agree with Chairman Giancarlo's long-held and well-articulated belief in regulation's ability to foster financial market innovation. I believe that the self-certification process of new financial products can play an important role in realizing that philosophy. Specifically, the self-certification process ensures that the market's introduction of new products is not delayed by regulators' political considerations. It reflects the government providing the market with the freedom and space to innovate outside of Washington bureaucracy and on a market time frame, not a bureaucrat's. And I think we can all benefit from that market-based approach. Let me also quickly take a moment to discuss the concept of risk, which is a term that seems to get thrown around very broadly, mostly with negative connotation in connection with our financial markets. For those who want regulators to remove all financial risk from the marketplace, I have news for you. That cannot and will not happen. Every element of the financial system has and always will have risk. Our market's ability to empower risk takers, to provide feedback on value creation vis-a-vis that risk, and transfer risk to those most willing and able to bear it, are what make our markets the envy of the world. I would seek to preserve those market functions, not bureaucratize them. As for today, while we're focusing on the self-certification process, I think a little perspective is also necessary. I must note that self-certification is where a new contract's regulatory life begins, not where it ends. After a contract's self-certification and its initial listing, the CFTC will then surveil that product's trading and clearing activity on a daily basis, review every new rule issued by exchanges and clearinghouses affecting that product, and regularly perform market-wide and clearinghouse-level stress tests incorporating that product's margin sufficiency. In addition to supervision by the CFTC, the trading of new contracts is subject to oversight by the exchanges to ensure that the contract complies with the core principles set forth in the CEA and CFTC regulations, including that the contract is not readily susceptible to manipulation and is subject to rules ensuring the contract's financial integrity. Further, as to risks assumed by FCMs, FCM positions are continually monitored, their trading activity is subject to potential trading halts, and their risk management policies are reviewed on a regular basis. Lastly, regarding public input, the CFTC is, and always should be, receptive to hearing public concerns regarding a new product and the process by which it was listed. I'm very pleased that this MRAC meeting has been convened to provide a forum to discuss any potential concerns that the public may have with the process for listing new and novel products. And I look forward to hearing today from participants about the types of risks that exchanges consider when deciding to list a new product, how exchanges assess whether a cash market is sufficiently transparent and liquid to support accurate and fair pricing for related derivatives products, and whether exchanges and clearinghouses have adjusted their risk management practices following particular product launches. In closing, I'd like to note that nothing says Valentine's Day like a Technology Advisory Committee meeting, so please mark your calendars for February 14th. I look forward to welcoming some of you back for that and appreciate all of your interest in it. We'll have a very robust discussion at that point of cryptocurrencies, blockchain, automated trading, and cybersecurity. But in closing, thank you, Commissioner Benham, and the members of the MRAC for coming here today and being with us and being a part of the discussion.
Thank you, Commissioner Quintens. Commissioner Benham?
Welcome again to the first Market Risk Advisory Committee meeting of 2018. I'm pleased to sponsor this committee and believe my timing to address important market risk issues could not be better. Groundbreaking new ideas have gone from theory to application in just the past few months. I'm especially mindful and appreciative of the Commission's ongoing efforts to affirmatively exercise its regulatory authority and expertise while remaining ever vigilant of the risks associated with the adoption of nascent technologies. Before we move into the substance of today's meeting, I want to thank Commissioner Quintens and Chairman Giancarlo for being here today and their contributions to this discussion. I also want to thank today's moderator, Paul Archizel. Before entering private practice, Paul spent more than 25 years at the CFTC in the Office of the General Counsel and as Chief Counsel in the CFTC's former Division of Economic Analysis, now the Division of Market Oversight. Paul played a leading role in many rulemakings that shaped our current processes for new product review and approval. Since leaving the Commission in 2003, Paul has remained an active and well-respected member of the Derivatives Bar. I want to thank each of the panelists. We have gathered a distinguished group of speakers, and their readiness to participate is greatly appreciated and critical to today's discussion. I want to thank Alicia Lewis, the committee's designated federal officer, Alicia started working in my office in mid-December, and MRAC was issue number 1 on day 1, and she's handled the role with great professionalism and discipline, and the quality of her work will be on display today. I also want to thank the members of the MRAC. Today we welcome 2 new members, Jason Cohen, Chief Executive Officer of NextCEF, and Kathleen Cronin, Senior Managing Director and General Counsel of CME Group. Jason and Kathleen will be taking the place of departing MRAC members John Nixon and Kimberly Taylor. Former Commissioner Bowen selected this impressive group, and you have all demonstrated the ability to tackle and opine on difficult and important issues. Your time and service is greatly appreciated. However, as many of you know, the charter for this committee will expire in the next few months. Today will likely be the last meeting of this group before we renew the charter and reconstitute membership. As I recently stepped into my new role as sponsor of this committee, it perhaps would have been sensible to renew, repopulate, and set a new course for MRAC all at once. However, the introduction of 2 Bitcoin futures contracts caused many to inquire, perhaps for the first time, about the Commission's role in the listing of new products under the Commodity Exchange Act and Commission regulations. While I commend the Chairman for releasing backgrounders on self-certification of Bitcoin products, recording a podcast roundtable with CFTC leaders on Bitcoin, and launching a Bitcoin education webpage, these communications can fall flat in the absence of meaningful dialogue. The launch of the Bitcoin futures product is a testament to the forward-thinking, innovative spirit of the derivatives market. As the market and market participants continue to adopt technologies that make new products, new relationships, and new forms of conduct possible, I believe it's critical that the CFTC engage with industry in addressing risk, provide legal and regulatory certainty to the market, educate the general public, and question and challenge the status quo, both in the market and within the Commission. Today's 4 panels are organized in order to ensure our dialogue remains focused on the issue of self-certification of new products. That being said, in thinking about this meeting and the Commission's recently announced approach and responsibilities with respect to virtual currencies, unquestionably new and novel assets, the overarching theme is largely one of process. We all should feel accountable for what we do, but also for what we do not do. And while we are now living in an age that is not big on process, but often prefers to emphasize likes and tweetable sound bites, process is important because it provides the bearings, the connections in the record and in the story of how we accomplish our duties. As the Chairman has recently noted, the CFTC has received some criticism from large market participants for not holding public hearings prior to self-certification of Bitcoin futures. That being said, as the most recent CFTC backgrounder notes, the product self-certification process does not provide for public input. And narrowing focus to the 2 Bitcoin futures contracts, the Chairman clarified neither statute nor rule would have prevented CME and CFE from launching their new products before public hearings could have been called. While the self-certification process does not expressly provide for public input, that does not mean that public input in the process of launching new and novel products is impossible or undesirable. To the contrary, dialogue between the Commission, the exchanges, and market participants is vital to the process. I am hopeful that today's MRAC meeting will both shed light on the importance of such dialogue and perhaps provide the public input regarding Bitcoin futures that did not occur prior to certification. At the very least, this meeting provides a forum for input regarding futures products in the virtual currency space. The CFTC staff developed a standard of heightened review within the limits and parameters of the current self-certification process for determining whether the Bitcoin futures products comply with the exchange's obligations under the CEA core principles and CFTC regulations and related guidance. I fully support and commend the staff under the direction of the Chairman for taking initiative and quick action in a timely and direct manner to address concerns related to the listing of Bitcoin futures contracts despite the regulatory confines of the self-certification process. However, the need for new heightened review process demonstrates that the Commission must reconsider its historical regulatory approach to new and novel products. In fact, the implementation of the heightened review process is a new regulatory approach in and of itself. The approach, albeit well-intentioned and appropriately calibrated to the level of risk presented by the Bitcoin products, has resulted in a muddled record, confusing story, and potentially a new hybrid process somewhere between self-certification and voluntary submission. Such changes require a more formal process subject to the rigors of commission deliberation and public notice and comment. I am pleased that the chairman has asked the CFTC's general counsel to propose for commission consideration possible regulatory and statutory steps to better support the staff's approach to virtual currency product review. I look forward to exploring our options, which I hope will include some parameters for determining when self-certification may not be appropriate, and for determining when such matters are appropriately brought before the entire commission. To be clear, this meeting is not intended to question the efficacy and usefulness of self-certification. Self-certification is a unique process that has served market participants, the CFTC, and the general public very well. Indeed, since Congress authorized the CFTC to establish a self-certification process for the listing of new products in 2000, exchanges have self-certified over 10,000 new products, providing more risk management tools for commercial end users across many different asset classes. As set forth in Part 40 of the Commission regulations, it is a process that relies on the Act and core principles as the benchmarks and standards for how an exchange and derivatives clearing organization must design a product. Any action above and beyond this must be subject to Commission action, so the Commission as a whole may deliberate the merits and consider the risks of new products in a transparent forum. Our first panel today will focus on the statutory and regulatory frameworks and processes with respect to the listing of new products and self-certification. A part of the discussion will be devoted to clarifying the different internal processes associated with self-certification versus voluntary approval. Of particular relevance to me is the Commission's flexibility under each of the governing Commission rules to assure the opportunity for thoughtful analysis and public comment only in appropriate circumstances. Our second panel will focus more specifically on how the Commission assesses initially and on an ongoing basis the adequacy of risk management and surveillance of new products. Panelists from Commission's Division of Clearing and Risk, Swap Dealer and Intermediary Oversight, and Enforcement will provide insight into how each of their divisions considers products that present novel or unique risk profiles, and how they go about developing the expertise necessary to accomplish their missions. Our third panel features representatives from DCMs and DCOs who will discuss the self-certification process from their perspective. Our fourth and final panel will address the question of novelty. The experts on this panel will discuss the question of novelty and whether the current self-certification process allows for adequate regulatory consideration when a product is itself determined to be novel or presents complex or unique issues. I am hopeful that today's conversation will serve to educate the public on the success of the self-certification process and perhaps shed light on what lies ahead in the virtual currency space. As market participants introduce new virtual currency products in the months and years ahead, I look forward to a broader conversation by the Commission in considering what steps can be taken to better evaluate novel products in a transparent manner, and to bring all ideas, concerns, and suggestions to best inform the general public about our process of review. In my view, novelty is a fleeting concept, which time consumes. But while novelty exists, it shines brightly and must be handled with care. Everyone in this room plays a key role in the success of the derivatives market. We all have unique and often diverse interests, responsibilities, and duties, but we also have many common interests, not the least of which is the promotion and support of healthy, safe, and transparent derivatives markets. As a regulator, I believe it's the Commission's responsibility to hold public meetings like these to educate, introduce fresh ideas, reconcile differences, and find solutions to new challenges so that market participants and the general public, our number one constituent, feels confident that we are fulfilling our responsibilities and can hold us accountable for our actions. Although difficult at times, it is our responsibility to ensure we are constantly learning from past actions and seeking better solutions to protect the public interest. I strongly believe this approach best serves all of us in the long run, and these markets continue to grow, innovate, and break barriers. I want to thank again everyone for being here today. the MRAC committee members, the speakers, Paul Archizell, Alicia Lewis, Commissioner Quintens, and of course, Chairman Giancarlo. I look forward to the discussion. Thank you.
Thank you all for your opening remarks. As Commissioner Benham stated, Paul Archizell will facilitate and help shape today's discussions during our panels. As noted in the agenda, the first panel will be on the self-certification of products. And I'll turn it over to Paul.
Thank you, Commissioner Benham and Ms. Lewis, for the kind introduction and for asking me to facilitate this meeting. It is an honor. Our task today is to examine the relationship of the Commission's product permissioning processes and market risk. It is a substantial undertaking, but hopefully by the end of the day, we'll all have a clearer understanding of the issues. I'd note that the Commission has had 3 separate product permissioning systems during its history. First, prior approval of all newly listed products was the process that was used from the time of the Commission's formation to about 1998. During a 2-year process, there was a 2-track system consisting of a fast track for routine new product listings and prior approval for novel products. Beginning in 2000, the current system of self-certification or voluntary exchange requests for prior approval was in place. It should be remembered that whatever process has been in place, the Commission has had an enviable place among regulators of fostering innovation in the market that it regulates. During its tenure, the Commission has overseen the introduction of financial futures, exchange-traded options, stock index contracts, and other new asset classes. There's been much debate accompanying each of these new introductions of new asset classes. It may be that today's discussion is part of that history. Finally, on a personal note, I would have to make clear that my appearance today is on my own behalf, and any views that I express are my own. Before starting our first panel, there are a few logistical items that I've been asked to mention to the committee members and invited speakers. Please make sure that your microphone is on when you speak. This meeting is being simultaneously webcast, and it is important that your microphone is on so that the webcast audience is able to hear you. Also, if you would like to be recognized during the discussions, please change the position of your place card so that it is vertical on the table, or raise your hand and Ms. Lewis will recognize you and give you the floor. Finally, although I'm facilitating the meeting, the purpose of MRAC is for members of the committee to be able to discuss the issues, ask each other questions, and ask the panelists questions. So please don't hesitate to raise your issues during the course of the meeting. Our first panel, as has been said, are the division directors of the Commission. We have with us Dan Davis, General Counsel, in the Office of General Counsel. We have Amir Zaidi, the Director of the Division of Market Oversight, and Brian Bussey, who's the Director of Clearing and Risk. With that, I'll turn it over to them for their opening statements.
Thank you. I'm Dan Davis, General Counsel of the CFTC. It's a pleasure to be here today. I want to thank Commissioner Benham and Ms. Lewis for the opportunity to speak. I always enjoy the opportunity to speak in public in front of my bosses, so thank you for that. I'll issue the standard disclaimer both for myself and for all CFTC staff who will speak today. We are, of course, here. We do not speak on behalf of the Commission, and that our views that we expressed are not necessarily the views of the Commission, the Chairman, or the Commissioners, or the agency as a whole. As Paul alluded to, I want to thank him for moderating as well. My role in my statement is to give a very brief history of the regulation and the self-certification process. As Paul noted, the main demarcation point for self-certification is the Commodity Futures Modernization Act of 2000, which introduced self-certification to the Commission. Prior to that time, it was a very different process at the Commission. If you were seeking a product approval, you would be relying on a process that had been in place since the Grain Futures Act of 1922. Under that regime, a Board of Trade had to submit every single contract for approval to the commission, and that there had to be a commission action to approve that particular product. Now, over the years, there were various factors that the commission considered when it was engaging in that product approval process. Some were broader than others, but probably the broadest factor was one that was included in 1974, which required the commission, when it was considering whether to approve a contract, whether that contract would not be contrary to the public interest. As a lawyer, a public interest standard is, relatively speaking, a quite broad standard, and it would allow a commission to consider all sorts of factors, basically any type of pro and con with respect to the acceptance or approval of a particular product. In addition, under the regime prior to the CFMA, there was no time limit whatsoever for the commission to accept or reject a product. So there was no statutory or regulatory deadline requiring the commission to act in any certain time frame. The rule approval process was similar in many ways. It also required commission approval, although the rule approval process, depending on what time period you were working in, involved different types of deadlines. During some periods of time, there was a 30-day period for review. In 1978, Congress added a requirement that the commission could take some additional time. They could take 60 days to review a rule if it involved something of major economic significance. And in that circumstance, it also required a public comment period. So the pre-CFMA process was subject to commission approval. Relatively speaking, a number of broad standards and considerations that the commission had to consider, and with products, no time limits, and with rule approvals, varying time limits depending on the time period and the specifically statutory regime that you were in at that time. That, of course, all changed with the CFMA, which introduced self-certification to the process. And there were a couple of key changes that were made with the CFMA. The first, I think, is the standard of review. For both products and rules, the basic inquiry that the commission was supposed to make was, for products, would the product violate the CEA and its regulations? And for a rule, would that rule be inconsistent with the CEA and the regulations? Now, of course, the self-certification process allowed registered entities to make that determination for themselves in the first instance, and allowed registered entities to make a submission to the agency stating that, in their view, the particular product or the particular rule that was seeking to be approved was consistent with or didn't violate the CEA and its regulations. So it's a narrower standard than the pre-CFMA regime. There were also time limits that were placed specifically in the CEA about rule submissions, and that's a lot of those were added as part of the Dodd-Frank Act. We're not talking as much about rule submissions today, but there were some time limits added there. There was, for the product approval process, if an entity decided to elect a product approval process with the commission as opposed to the self-certification process, there were some time limits that applied there. Now, with the CFMA coming into play in 2000, the commission, of course, has promulgated regulations with respect to both product self-certification and rule self-certification. Those rules have been modified a few times. The product self-certification, which is found in 40.2, has been, it's adopted originally in 2001. It's been modified twice since that time. Under the current regime, under 40.2 for self-certification of products, when a registered entity certifies that a product complies with the CEA and its underlying regulations, it can list that product for trading the next business day. That is not a specific time requirement that it's stated in the CEA itself, but it is the regulatory requirement that has been imposed by the Commission. There are two circumstances under which a self-certification process, self-certification for a product can be stayed by the Commission, and those are laid out in 40.2. That is, if the Commission has begun a proceeding for false certification, asserting that there is some false element of the self-certification itself, or if the Commission has invoked Section 8A7 of the Act, which allows the Commission to impose new terms and conditions or new rules on the registered entities. And so in those two circumstances, that's when the regulation allows the Commission to stay self-certification of a product. The prior approval process for products is found in Part 40.3. That allows a longer period of time for the Commission to review, a 45-day period, which can be extended for an additional 45 days if it involves a novel or complex issue, there's an inadequate explanation provided by the registered entity, or if the Commission determines that it's potentially inconsistent with the CEA. There are similar provisions for rules, both self-certification for rules and prior approval for rules. For self-certification for rules, which is found in 40.6, a rule is certified and takes effect within 10 business days unless the Commission decides to stay the rule. The Commission can stay the rule under 40.6 if it prevents a novel or complex issue, there's an inadequate explanation given, or it's potentially inconsistent with the CEA. The prior approval process for rules, that's found in 40.5. Like the prior approval process for products, there's an initial review period of 45 days, which can be extended by the Commission in certain circumstances. So that is a brief summary of the background with respect to the self-certification process, and I look forward to the discussion with the committee regarding this process.
Morning. Thank you for having me today. My name is Amir Zaidi. I'm the Director of the Division of Market Oversight. And today I will discuss the new product review process from DMO's perspective. While there has been much focus on the self-certification process these past few months, I think this discussion mostly misses the point. The real issue is the standards a DCM must meet when listing a new contract and whether those standards are appropriate. From DMO's perspective, we focus on Core Principle 3, Core Principle 4, Core Principle 5, among other requirements that go towards protecting the integrity of the futures market. A lot has been thrown around the term readily susceptible to manipulation, but what does that actually mean? I'll give an overview of these standards today. When exchange self-certifies a new contract, it is asserting that the product complies with the CEA and the Commission regulations. Core Principle 3, as I said, requires that a DCM only list contracts that are not readily susceptible to manipulation. Core Principle 4 requires that a DCM have the capacity and responsibility to prevent manipulation, price distortions, and disruptions of the delivery and cash settlement process through market surveillance, compliance, and enforcement practices. Core Principle 5 requires that DCMs adopt as is necessary and appropriate position limits or position accountability levels. Now, under Core Principle 3, there are no rules, but the Commission has issued guidance. The guidance provides further detail for cash-settled products. It says cash-settled contracts may create an incentive to manipulate or artificially influence the data from which the cash settlement price is derived, or to exert undue influence on the cash settlement price's computation in order to profit on a futures position in that commodity. Careful consideration should be given to the potential for manipulation or distortion of the cash settlement process, as well as the reliability of that price as an indicator of cash market values. It also says when an independent private sector third party calculates the cash settlement price series, a DCM should verify that the third party utilizes business practices that minimize the opportunity or incentive to manipulate that cash settlement price series. Such safeguards include lockdowns, prohibitions against derivatives trading by employees, or public dissemination of the names and sources and the price quotes they provide. Because cash-settled contracts may create incentive to manipulate or artificially influence the underlying market from which the cash settlement price is derived, or exert undue influence on the cash settlement computation in order to profit on a futures position in that commodity, a DCM should, whenever practicable, enter into an information sharing agreement with the third-party provider, which would enable the DCM to better detect and deter manipulative behavior. Under Core Principle 4, there are also requirements for cash-settled contracts. For cash-settled contracts, a DCM must demonstrate that it monitors the pricing to the index to which the contract will be settled and monitors the continued appropriateness of the methodology for deriving the index and makes a good faith effort to resolve conditions, including amending the contract terms when necessary, where there's a threat of market manipulation, disruptions, or distortions. If a contract listed on a DCM is settled by reference to the price of a contract or commodity traded in another venue, including the price or index derived from prices on another DCM, the DCM must have rules or agreements that allow the DCM to access information on the activities of traders in that reference market. The DCM must have rules that require traders in its contracts to keep records of their trading, including records of their activity in that underlying commodity and related derivatives markets, and also make such records available upon request to the DCM. Appropriately, the guidance and rules focus on protecting the cash settlement process and any index that the futures contract settles to from manipulation. Much attention is spent by DCMs and the CFTC staff to ensure that the index is constructed in a way to prevent such manipulation. For example, DCMs and the CFTC staff look at the liquidity and number of transactions making up the cash settlement process. If an outsized trade could affect the settlement process and convergence of cash and futures prices. This is appropriate because any manipulation could affect the futures market and manipulators could potentially profit on futures market positions. Futures integrity is obviously squarely within DCM's and CFTC's mandate. For DMO staff, in its review of products, it focuses on these contract design issues like the construction of the cash settlement process. However, it is not the responsibility of DCMs or the CFTC to oversee on a daily basis every cash commodity market or make suitability judgments about the underlying commodity market and whether a futures contract should be able to be listed on it. Rightly, we are not overseeing cash markets and participants on a daily basis for abusive practices and risks. Every cash market underlying futures contracts can be manipulated. Gold, silver, FX, Bitcoin cash markets, they can all be manipulated. However, making detailed judgments about the level of manipulation generally in those cash markets, and if it is too little or too much to list a futures contract, is a different analysis from whether a futures contract is readily susceptible to manipulation. Going down this road would be a huge expansion of our and DCM's responsibility and jurisdiction and is inconsistent with decades of precedent under the CEA. While we are attentive to the general manipulation concerns in the cash market, for example, through our enforcement authority, DMO's analysis of whether a contract is readily susceptible to manipulation from a futures contract listing standpoint always ties back to the integrity of the futures contract and the settlement process. That is why contract design issues are so important to ensure that the cash settlement process cannot be manipulated through, as I said, outsized trades or other factors. In addition, DCMs and CFTC have the obligation to conduct surveillance on traders in the derivatives markets and, when deemed appropriate or necessary, make inquiries into the activities of the underlying cash markets. Again, this ties back to the futures market integrity. That is why our rules require DCMs to have rules that allow it to have access to information on activities of its traders in the reference market. Likewise, DCMs and the CFTC monitor prices in the derivatives market vis-a-vis the cash markets to identify potential manipulative behavior or to assess proper functioning of the derivatives contracts. This limited monitoring, as I said, all ties back to the futures contract and is appropriate to protect the integrity of the futures contracts. Questionable social utility and price valuations of a new asset class are not sufficient reasons for the CFTC to set regulatory policy based on personal value judgments, however considerable the inherent risk associated with that new asset class. Moreover, to the extent that commercial interests agree that there is legitimate value in using the underlying asset, the CFTC should allow the introduction of derivatives on those assets for risk shifting and management purposes. Unless Congress decides to ban certain cash commodity trading, our job is simply to ensure that the futures contracts based on those cash commodities, including any cash settlement process, are not readily susceptible to manipulation. Finally, rules under Core Principle 5 that require that cash settled contracts DCMs adopt spot month position limits that are no greater than necessary to minimize the potential for manipulation or distortion of the contracts or the underlying commodity's price. The CFTC understands that the presence of position limits reduces the ability and financial incentive for market participants to attempt to manipulate the contract or underlying cash markets. Thank you very much, and happy to answer questions after Brian goes.
Thanks, Amir. Thank you for having me speak today. As mentioned, I'm Brian Bussey, Director of the Division of Clearing and Risk. The focus of this panel is on DCMs and CEFs and the self-certification process, but I wanted to take a few minutes to talk about the Division of Clearing and Risk and new products from a process perspective. You have the good fortune of having me on the second panel as well, where I'll talk more from a risk perspective, the approach that we take in clearing and risk on new products. While DCMs and CEFs are required to file a certification under Regulation 40.2 before listing a new product for trading, derivatives clearing organizations are only required to file a certification under a separate regulation, Regulation 40.6, which generally covers any new rules or rule changes, only if a rule change is required before clearing of the product can begin. As you probably know, many new products do not require new clearing rules or clearing rule changes. So oftentimes we do not receive formal certifications under Regulation 40.6 for new products. In the event a new rule or rule change is necessary, a DCO will typically provide draft copies of the certification in advance of the formal filing under Regulation 40.6, and this is particularly the case for significant rule changes. This allows the staff on an informal basis to ask questions, seek additional information, and provide feedback before the formal filing. Once that filing occurs under 40.6, there's a 10-day period, and 40.6 gives the Commission the ability to stay the 10-day period, giving the Commission an additional 90 days during which to consider the filing, and we're also required to do a 30-day public comment period under Regulation 40.6. But again, this process is only required when there is a new clearing rule or clearing rule change that's required for a new product. Even when the proposed clearing of a new product does not require a filing under Regulation 40.6, there are usually informal discussions between DCR staff and the DCO when a DCO plans to clear a new product. And this is particularly the case when the new product is novel or complex. During these discussions, DCR staff may and often does request that the DCO provide certain data and background information. How extensive these discussions are and how far in advance they take place depends on how novel or complex the product is. Finally, I wanted to touch briefly on Regulation 40.10. Under Regulation 40.10, as many of you know, a DCO that has been designated as systemically important by FSOC, something that we call a SIDCO, must give 60 days advance notice of any proposed changes to its rules, procedures, or operations that could materially affect the nature or level of risks presented by the SIDCO. The regulation further defines materially affect the nature or level of risk presented as matters as to which there is a reasonable possibility that the change could affect the performance of essential clearing and settlement functions or the overall nature or level of risk presented by the SIDCO. As of now, we only have two SIDCOs. Those are CME and ICE Clear Credit, but the OCC, the Options Clearing Corporation, and our other DCOs are not SIDCOs, so they would not be subject to the 4010 process. Historically, DCR staff has not viewed the clearing of a new product standing alone as a change that could materially affect the nature or level of risks presented by a SIDCO. DCR has reviewed new products pursuant to Regulation 4010 in the past, but when it has done so, it has been in combination with a new margin methodology or changes to an existing margin methodology or other changes to risk management involved with the introduction of the new product. Growth in the clearing of new products, as you know, is typically quite slow, allowing DCR to monitor the risk management of the products in greater depth over time, something that we'll talk about on panel 2. Bitcoin is an example of that. After 6 weeks, we have open interest of around 40 million at each of the two clearinghouses clearing the Bitcoin futures. And again, as you all know, $40 million for OCC or CME is a very tiny fraction of the overall open interest at those two DCOs. And with that, I will turn it back over to Alicia and Paul to continue to moderate the panel.
Thank you. That was very enlightening. One of the topics that Mr. Busse mentioned was about the informal review processes that take place around new products or new rules. And I'm wondering if maybe we could have a little bit more of a discussion about what those informal processes are, how people know about them, whether there should be more formal processes, what are the relative merits of a formal versus an informal process pre-certification. I think that would be something for the panel, and perhaps the committee also would like to discuss the relative merits of formal versus informal processes, and maybe starting with the panel discussing what the informal processes are and how they operate.
So the formal part of the process for a new product is the 40.2 process through the Division of Market Oversight. As I said, in most cases, new products do not require a formal process on the clearing side. So the notice is there's not a formal process for commission notice on the clearing side when there's not a rule filing. Of course, the DCOs, and I'll allow them to speak for themselves, oftentimes talk with their membership, their risk committees, and so forth as part of their governance process to discuss the launch of new products. That's something that is done separate and apart from the regulatory process here at the commission. In terms of the actual process that we go through, again, it depends on the nature of the product. For relatively routine submissions, there's not very much process. The next wheat contract is not something that will generate a lot of focus in the Division of Clearing and Risk. Instead, we deal with those products more on an ongoing basis through our risk surveillance efforts. For more novel and complex products, the process, again, informal, but involves outreach by the DCO to us or colleagues in DMO talking with us about a new product and resulting in outreach to the DCO to discuss the risk management of the product. For the sake of time, Paul, that process I can certainly talk about here, but we were going to talk more about that in panel 2 in terms of what our risk focus is. If you'd like me to do a bit of a preview here, that would be fine. But
No, I think maybe we can talk about the informal process in DMO for new product approvals
sure.
and certifications.
Like Dan said, I mean, it's more of a formal process either through the self-certification or approval, but for self-certification, most contracts, as all of you should know, that really don't trade have any volume. So we're not necessarily looking at every single product that comes in, but when there is something unique, such as the recent Bitcoin contracts, exchanges and DMO have a very good relationship. So they come in, talk to us about those products. We see draft terms and conditions. Just like the recent processes, we spent several weeks and months talking to the exchanges about the contract and seeing draft terms and conditions, talking about issues, making improvements. So that's generally how the process goes for kind of through the self-certification process. Like I said, at the end of the day, exchanges will take care of any issues that we raise, just like they did in this situation, and we were comfortable with the products at the end of the day.
And just from an OGC perspective, obviously we don't review every product that comes in either. We await word from DCR and DMO if there are any particular legal questions or particular concerns about a particular product, and we'll discuss those as those issues arise.
So I guess a follow-up question would be, what are the benefits of an informal versus a formal process? And is it possible under the statute to make more formal the process which is operating as an informal process now? And that might be something that members of the committee have a view or questions on as well.
The chair recognizes Biz.
Hi, good morning. Hi, good morning. Thank you, Alicia, for the opportunity, and thank you for the chairman, the sponsor, and for Commissioner Quintus. I'd like to first of all say that, as a market participant, we fully acknowledge and support the self-certification process because it's led to tremendous innovation in products, which is something the market needs. The one question, I would like to ask the panelists is that especially maybe, Amir as, the DMO, you mentioned that it's probably impossible to surveil every underlying cash product, and it's kind of completely beyond the mandate that the DMO currently has. And your mention about the underlying informal dialogue with the exchanges or the DCMs listing new products, what part of the dialogue focuses on the fact that the underlying product itself, the cash product itself, may be in a relatively new state of maturity in the marketplace, or the nature of the participants that play in it? Or could you shed some light if that discussion also focuses on the fact that the underlying cash product itself may not be regulated currently?
Can I remind everyone to just please speak into the mic so that we can hear you?
Sure. Thanks for the question. Like I said in my remarks, we do take into account the underlying cash market, but its historical practice has been really to focus on the contract design and how for example, in this case, the index is constructed for the cash settlement process to ensure that the futures contract is not readily susceptible to manipulation. So there are things that you can do with constructing the index, as you know, adding more cash market platforms, transactions, to make sure that the product is liquid, making sure that certain outsized trades don't have an influence during that settlement process, looking at kind of collars around those settlement prices to ensure that the settlement price is not too outside of the index. So those are things that our product review group and DMO focuses a lot with the exchanges. That's what we did in this process for the Bitcoin futures contracts. As you know, our surveillance and division and CFTC has general fraud and manipulation authority in the cash market. But from our purposes for DMO, we're mostly focused on how that settlement process is constructed, tying back to the futures market integrity, like I said. And as I mentioned as well, there are other safeguards in place as far as monitoring and some of the monitoring that the exchanges are doing of their futures market participants and their positions in the cash market, so they're not potentially going into the cash market to manipulate, to affect futures prices. So that's really historically what we've been focused on, and that's kind of in line with what we've done in the enhanced review process.
The chair recognizes Kathleen Cronin.
Yeah, one observation I just want to make specifically with request to the question on the formal versus an informal review process with the commission staff. I think that CME is very cognizant of the fact that if we're listing a new product that's unique or has different characteristics from what's currently listed, that it's important for us to make sure that the commission is not surprised by that filing and that the staff is comfortable with what we're doing. And from my perspective, and I think from what I'm hearing from the staff, that informal process has worked well over the years. To impose a formal process, I think, unnecessarily creates administrative burdens that aren't necessary in connection with the listing of new products. If it's worked so far and there haven't been any problems, I think the creation of formal processes will just impose more burdens on the staff and impose more burdens on the exchange to comply with formalistic requirements that aren't necessary in connection with listing a particular new contract.
The chair recognizes Marnie Rosenberg.
Thank you, Alicia. Marnie Rosenberg from JP Morgan. Thank you to Commissioner Benham and Chairman Giancarlo and Commissioner Quintas for your opening remarks. One thing that I think would be very helpful, and I would direct this to Daniel or Brian, is in the context of the different rule provisions that you outline for self-certification and for approvals, in which circumstances is there any kind of mandatory public comment period? I think just kind of that overview would be very helpful.
So I think, as I mentioned in my remarks, in 40.2, which is the self-certification for products, there is no regulatory
Dan, I'm sorry,
provision.
can you speak into the mic?
Sorry, there is no regulatory provision in 40.2 for public comment. There is the availability for public comment, both in prior approval for products and prior approval for rules. Those are provisions that can be extended up to 90 days. And so in that 90-day period, there is sufficient time to have a public comment process.
And then in 4010, there is not a provision in the rules or in the underlying statute, which is Title 8 of the Dodd-Frank Act, for a comment period, although just recently we did a comment period for a 4010 filing, the first time we've ever done that.
Kathleen, do you have another question?
Okay, perhaps we can talk a little bit about the yardstick that the Commission uses in reviewing those contracts which have been self-certified. Amir, you talked about the fact that you have guidance that you look to towards seeing whether or not a new contract meets Core Principle 3, 4, and 5. And I think that's found as an appendix to Part 40, and it's a rewrite of the old guideline number 1. I don't think that's been updated for many years. And I think one question might be, is the guidance that is put out that you look at current, and would it be beneficial to have that be updated?
Sorry, are you talking about the guidance under Part 38 or Part
Yes, sorry.
Part 40? Okay. Yeah. So under, like I mentioned, Core Principle 3, there are no rules, but the Commission published guidance to Part 38 outlining what it looks for when a contract is if a contract's readily susceptible to manipulation. I'm not exactly sure when the guidance was last updated, but I know during the DCM rule proposal and final rule during Dodd-Frank back in 2012, 2013, the DCM rules were updated, so it's possible that the guidance was looked at that point. The guidance, as many of you probably know, is general. It doesn't make a distinction between certain contracts versus other contracts. It's something that we have been looking at recently, but we haven't made any decisions as far as if it needs to be updated or what parts of it may need to be updated. So that's something that could possibly be looked at.
The chair recognizes Kristen Walters.
Thank you, and thanks for including me in this forum. Just a question. So I understand that when we talk about new products, that the focus is on the contract design, index, construction, settlement on the exchange. And I certainly think that makes sense in the context of traditional financial assets and or underlying commodities. I guess just would like to understand the views in looking at the research and views from central bankers, my firm, risk managers on the risk associated with Bitcoin. Most of the dialogue is around the fact that Bitcoin and other cryptocurrencies are a very small component of financial markets in general, thus not concerned from impact on monetary policy or on financial markets. But just given the rapidly evolving nature of cryptocurrencies in general and the underlying nature of the asset, so from my perspective, it's not clear if cryptocurrencies are currencies, commodities, securities, if they provide value. And there are some significant challenges around valuation. So you have an asset that has no cash flow, no earnings, no interest rate, extreme volatility, even in the market cap of these currencies, and with very, very large assumptions that need to be made to even consider like a value. So I guess the question is, with that backdrop and for this specific type of product, at what point would you think it might be necessary to move from an informal process towards something more formal as this type of product evolves?
Like I said in my remarks, things about risk, people's perceptions of value of Bitcoin or other commodities are not necessarily something that we are looking at in the product review, futures contract listing process. What our statute provides is to look whether that contract is readily susceptible to manipulation. So that's what we are focused on. If that's something, that road we want to go down about making risk judgments or value judgments of just the underlying, although DCR looks at risk from a DMO's perspective, if we're going to look at risk or trying to determine if the price of Bitcoin or other cash virtual currencies are appropriate, I think that takes us down a dangerous path.
So I understood your opening remarks and what you've said. I guess from my perspective, given the nature of this product, which is very different than anything that we've seen cleared on futures markets, how do we not go down? Like, I feel like it's dangerous not to go down the path. So at the current point, the market cap is 500 billion to 800 billion of these cryptocurrencies with like massive volatility and a very significant lack of clarity around some of the major risks. So I understand that given it's small today, that argument makes complete sense and it's consistent with your rules and how you oversee the markets. I guess my question was intended to get you to speak about if the size of Bitcoin and cryptocurrency in financial markets starts to increase where it is significant, would that not be something that you would need to think about? So actually, if you have an asset that you can't value, if it has no cash flow, if you can't even categorize what the asset physically is, at what point would you take a look at the CFTC's rules and perhaps evaluate that issue?
Well, some of the issues in your initial remarks are issues that the risk group in Division of Clearing and Risk looked at in their discussions with the Options Clearing Corporation and CME. So we took some of those issues into account, the length of time that the underlying has been trading, the time series that we have available for doing back testing and other analysis. And then on a going forward basis, we've been monitoring this product even with the very small amount of activity in the product and the small amount of open interest. We've been focusing on it very intently. But from a DCR perspective, you would need to, I think, make some significant changes to the front end process if you wanted to do that type of analysis on a formal basis, potentially even requiring a statutory.
Brian, can you please speak into the mic?
Sure, potentially even involving a statutory change, and part of the challenge. And again, we were facing Bitcoin in late October, early November, up to the launch, not sure how big it's going to be, and it turns out it's thus far not been really a significant product. So it's this question of balancing between, to CME's comments earlier, balancing between informal processes and more formal processes, not knowing what the future holds. But we're not done. we did our work leading up to the self-certification at the beginning of December. But Bill Heitner, who's going to be speaking on the next panel with me, his team in Chicago is focusing on this on a daily basis and considering risk issues in this product, keeping on top of it. So.
And I think the next panel will talk a little bit more about post-launch, but for pre-launch, I guess as a follow-up to your question, one issue would be, what does the statute permit and what flexibility does the agency have to vary the current current processes that are in place? And do you see any possibility for having different processes pre-launch or what you have required by the current statute?
I'm not going to give definitive advice in this forum, but I will say that those are issues that we are looking at. Obviously 5cc says what it says, and we're bound by those terms. And so we are looking into questions as to what flexibility there is within 5cc with respect to timeframes, with respect to standards for thinking about stays, with respect to any type of a pre-certification process. As I think as both the chairman and Commissioner Benham noted, that is something that we in OGC are evaluating at this time, and obviously we appreciate forums like this where we can get ideas from the committee about what they think might be possible options in that realm.
The chair recognizes Marcus Stanley.
Thank you. Just a couple of questions based on some things that have come up in this discussion. So the first one to Brian, it appeared that you were saying that under the 4010 Title VIII process, you had kind of a general policy that new products would not be a change that that would require advance notice, that they would not be a change in procedure or operations that even could materially affect the nature and level of risks presented by the CITCO. And I just wanted to ask, I mean, given that the introduction of a new product, it may have a small amount of trading initially, but the fact that the new product has been introduced could mean that further down the road, there could be significant changes in the nature of level of risks that would not be accompanied by any change in rules or any other change that would require a 4010 review. So isn't that an initial introduction of the new product potentially your only chance to apply the intent of Title VIII to ensure a CFTC and, I would add, Federal Reserve review of the risks presented by a clearinghouse? So I'll let you answer that first.
Sure. I mean, first off, as I pointed out, it's in this context of Bitcoin futures, it would only have been CME and not the OCC that would have been subject to 4010. So even if we thought it was the right thing to do to invoke 4010, or if we could have invoked 4010, it would have only been a process that applies to CME, not to the OCC, and not to 14 of our 16 currently registered DCOs. It's only 2 of 16 that are registered as CITCOs. And I think but more specifically to your question, it's not that in no circumstance would we invoke 4010 for a new product. Our practice has been when it has been combined with an actual change to the rules or to operations or procedures. In the case of CME, when we looked at this, CME indicated to us that they did not require a rule change to launch the product. We had discussions with them. We checked on that, and we agreed that there was no rule change that was required in terms of operations and procedures. They proposed to use their existing margin methodology without changes either to their margin methodology or to their existing risk management practices. So I'm not saying definitively, but I think it would be hard to find a change there that would warrant a 40-10. But then going back, 40-10 is not an across-the-board solution, even if we were to invoke it for new product launches of the type that Bitcoin futures represented, where there was no rule change, no change in margin methodology, no change in other risk management practices. In contrast, I think swaptions, the introduction of swaptions by CME was an example where we did invoke 40-10 that involved a change to their margin methodology. And so we focused on that as a 40-10 because it was both a new product combined with a change in their proposed margining approach for that new product.
I guess I'd say that when you apply an existing margin methodology to a very new product, that could be an effective economic change in what that methodology is really doing or the risks posed by it. But I guess the other question, just to Mr. Zaidi, I just wanted to be clear on the position that you were taking. That it seemed in your last response to Ms. Walters and also to the gentleman from Citibank that you were taking a very strong position that the statute restricted you to just looking at whether a contract is susceptible to manipulation, and that asking the question of the relationship between the contract and the underlying, or whether there were fundamental weaknesses in the market for the underlying, would take you, as you put it, down a dangerous path, and that you simply almost felt that you couldn't look through to the underlying. Is that?
Right. So like I said, that's where the statute focuses on. That's where our guidance has focused on. Historically, the practice has been for DMO to look at that settlement process and how the index is constructed, how the futures contract is constructed. It all ties back to the futures market, obviously, because that's what we have jurisdiction over. So I'm just making the point that to broaden that jurisdiction now going to looking at more and more in the cash market is just something that we should really think about before we go down that path.
We're going to take two last questions, and then we're going to break. The chair recognizes Dale Michaels.
Thank you. And the Options Clearing Corporation, we do clear the CBOE futures contract. But I'd make sure that the committee also recognizes and doesn't confuse the terms of formal versus informal and shallow versus thorough, because the things that the CFTC did here was a thorough research of the product. We had many conversations with the CFTC along with our risk committee, and I'll talk about this more on the third panel to give a bit more transparency to the governance process. But there was a great deal of research done looking at the modeling of the Bitcoin product with the cash, looking how the margins and looking at the back testing, how the models would react to the Bitcoin product. It was taken into account going back to times when the Bitcoin was even more volatile than it was now. This led to a lot of discussions, a lot of information sharing with the CFTC, a lot of discussions around the overall risk management characteristics and whether the models could handle it, whether the stress testing could handle it. So I would make sure that the fact that it's a informal versus formal does not to mean that it's not a thorough process that is being done, or at least has been done from what I could see from the Bitcoin product when we were looking to clear it.
The chair recognizes Kathleen Cronin.
Yeah, I'll make my comments brief so that we can then go to the break. A couple of observations with respect to Bitcoin and the comments that have been made with respect to the novelty of the product. There's no doubt that Bitcoin is relatively new, although it has been around for a number of years, but is the subject of increasing focus. I think it's important, though, to remember that what we have listed is a futures contract on a commodity that's cash settled to an index. So in connection with that, we have all the protections in place that you have with respect to a regulated futures contract to minimize volatility and ensure that we have the appropriate margining to address any risk that's posed. And similar to any of our other contracts, after a product begins listing, the risk profile can change significantly, and that's addressed through the protections we have in place and through the appropriate margining of the contract. So to that extent, this contract is not that different from other contracts that have demonstrated volatility in the past. Thank you.
Okay, at this time, we'll take a 15-minute break. Thank you. Oh, a 5-minute break? Thank you to the panelists.
Test, test, test. This is mic number 11 in the chain. Test, test, test. Test, test, test. 1, 2, 1, 2. Test, test, test. 1, 2, 1, 2. Test, test, test. Test, test, test. This is mic 11. I'm hearing a little feedback. This is mic 11. Test, test. Test, test, test. Test, test, test. I'm going to move on to mic 1. You hear that? Test, test, test. 1, 2, 3, 4. I'm moving to mic 1. Test, test, 1, 2, 3, 4. This is mic 1. Test, test, test. Mic 1. Test, test, test. Mic 1. This is mic 1. Testing, testing, testing. Mic 1. Mic 1. Test, test, test. You need more? Test, test, test. Mic 1. Testing, testing, testing. This is mic 1 test. Do we need more? Test, test, test. Mic 1. Control, do we need more? Test, test, test. Mic 1. What are we doing?
Could everyone please be seated? Could everyone please be seated? Ladies and gentlemen, please be seated. We're about to start. It's my pleasure to call the meeting back to order. And now we will have the second panel, New Products from a Risk Perspective. And I'll turn it over to Paul.
Hi. So the second panel, we have 4 panelists. They'll each give them a short introduction of themselves. We have Brian Bussey, who's the director of DCR. We have Bill Heitner, also from DCR. Matt Culkin, the director of DSIO, and Jamie McDonald, the director of the Division of Enforcement. So with that, I'll turn it over to them. They each have a statement to make to start with.
Thank you, Alicia. And, Paul, you get the benefit of seeing me again and hearing me again speak. This is Brian Bussey from Division of Clearing and Risk. The Commission has a range of tools that address the risk management and oversight of cleared products. Specifically, there are many requirements under the Commission's regulations related to risk management at both the DCO and clearing member level. Among others, Regulation 39.13 contains risk management requirements for DCOs addressing, among other things, margin requirements and margin models, back testing, and stress testing. Regulation 39.19 requires DCOs to report to the Commission on a daily basis initial and variation margin, other cash flows, and end-of-day positions. As Bill Heitner, to my left, DCR's head of risk surveillance will discuss shortly, staff in risk surveillance use this information to perform daily risk surveillance among other oversight tasks. And I just want to stress, coming off the first panel, the certification process in DMO and the informal process that DCR often takes with respect to new products is not the end of the process. It is just the beginning. And Bill will detail a lot of the work we do on a daily basis once a product has been launched to monitor the risk, the risk at the DCO, buildup of risk at clearing members and at the individual large trader level. And then there's regulations 1.73 and 23.609. These are risk management requirements for FCMs and swap dealers that are clearing members, including, among other things, requirements for stress testing and liquidity testing. This is ongoing work that we do and ongoing requirements that clearing members have to address risk in the clearing system. From a process perspective, the division's oversight efforts with respect to new products break down into pre- and post-launch activities. Again, risk surveillance is a key part of that, which Bill will discuss. There's also a very big piece of our program that's examinations. The division conducts on-site examinations of DCOs to ensure compliance with DCO core principles and relevant regulations, with a particular emphasis on risk management. A lot of our focus is on the systemically important DCOs for obvious reasons. These are examinations that are occurring every year at the systemically important DCOs. From a pre-launch perspective, as I discussed on the first panel, not every new product product requires a rule filing or formal notification to the Commission on the clearing side. But even when a rule filing is not required, there are informal discussions between DCR and DCO when a DCO plans to clear novel or complex new product. A focus of these pre-launch discussions usually is margin requirements for the new product. DCR staff may and often does request data and background information to assess the use of the model and the proposed margin requirements that are being produced by that model. Depending on the circumstances, those discussions can be quite extensive. I think Dale referenced the discussions in his remarks on panel 1, quite extensive with OCC on Bitcoin futures, as well with staff at CME. There are a number of margin-related requirements for DCOs under our regulations. A DCO's margin model and each parameter of that model must be risk-based and reviewed regularly by the DCO. Initial margin requirements must be commensurate with the risks of each product and portfolio. A DCO must use a minimum liquidation time or margin period of risk of 1 day for futures, options, and swaps on certain commodities and 5 days for other types of swaps. And then the Commission has the authority by order to establish shorter or longer liquidation periods for particular products or portfolios. And then initial margin requirements must meet a 99% confidence level. This translates to an expected value of no more than 2 or 3 margin breaches in any given year. And I can tell you from the work we did with both OCC and CME, where they ended up with their margin requirements is well above that 99% confidence level, the minimum required by our regulations. In fact, it approaches 100% confidence level based on available data that we have going back 5 years in Bloomberg. These requirements are particular focus in a pre-launch review of novel or complex products. And then there are some additional ongoing requirements related to margin, including that the DCO must review and validate their margin models regularly. They must review the adequacy of their initial margin requirements on a daily basis and conduct daily and monthly back tests to assess the adequacy of initial margin requirements. And again, as Bill will discuss, that's something that we do as well as a check on the DCO's activities, and we do those quite regularly as well. So with that, I think I will turn it over to Bill to talk a bit more about this very important ongoing risk surveillance that we do.
Thank you, Brian. I'm Bill Heitner. I'm going to talk a little bit today about the division's risk surveillance activities and give some examples as to how they relate to the new Bitcoin futures contracts. The division performs a number of surveillance and oversight activities to ensure that clearing-related risks are being properly managed. The division performs daily risk surveillance in which we attempt to identify and quantify risks in all cleared products. These products include futures and options, credit default swaps, interest rate swaps, and foreign exchange swaps. The division performs clearing member compliance reviews, which involve on-site reviews of clearing members to ensure that they're in compliance with risk management requirements under Regulations 1.73 and 23.609. The division performs margin model reviews of new margin models and changes to existing margin models to ensure compliance with Commission regulations. And the division has a margin model backtesting program. Commission Regulation 3913 requires DCOs to conduct margin backtesting to assess adequacy of initial margin. The division also has a backtesting program. The division's backtesting program has 2 objectives: to test the adequacy of initial margin for benchmark products at DCOs, and to monitor the performance of DCO risk management policies with respect to setting initial margin. Now I'd like to give you some examples of some of our efforts as they relate to the new Bitcoin products. Since the initial launch of Bitcoin futures products, we've been receiving data from the DCOs. This data includes positions, margin, and cash flow. We use this data to create position reports for both large traders and clearing members. Our large trader reports calculate net positions, total longs, and total shorts across both DCOs. We also calculate positions for clearing members, and we stress test those positions. Our stress tests are at price changes of 100% price moves both up and down. And then we calculate those losses and we compare them against margin on deposit for the clearing members' financial resources and the financial resources of the DCO. We also calculate and review margin erosion. That's the change in price compared to the margin rate. We look for margin breaches, and we look for consistently high price fluctuations relative to margin. We prepare a weekly report, which is distributed to the chairman, the commissioners, and other divisions, summarizing our findings. In the event that we identify any concerns related to risk related to a trader or a clearing firm, we would contact the clearing firm or the DCO to discuss corrective action. Similarly, if we identify any risk related to margin, we would contact the DCO to discuss potential changes in the margin model. To date, we have not determined that we need to take any corrective actions. I would like to note as well that based on the open interest in Bitcoin futures at CME and OCC, that risk in Bitcoin futures is relatively small related to the financial resources of the clearing firms and the DCOs. With that, I'll turn it over to Matt Culkin.
Good morning, everybody. Thank you for having me. I'm Matt Culkin. I'm the Director of the Division of Swap Dealer and Intermediary Oversight, DSIO. I'd like to just give a brief overview of our division's regulatory oversight function as it relates to the risks posed to intermediaries and market participants associated with listing new products with novel or unique profiles. So our role is primarily focused on the approximately 60 active FCMs, the SROs that monitor clearing members of CME and the NFA, and the thousands of registered commodity trading advisors, commodity pool operators, and introducing brokers. I'd like to just touch on 2 points. So first is the role that we play through regulation and examination, and this is for all contracts, and it's designed to identify and mitigate possible risks to the market and to ensure the effective operation of market intermediaries, including the safe holding of customer funds. Second, and I'll touch on this in a moment, as it relates specifically to novel products, we've worked closely with colleagues in DCR, DMO, and enforcement, as well as at the NFA. So on the first point, we implement the Commission's regulations as they relate to intermediaries. So with respect to FCMs, our rules require and our staff examiners review for compliance with a series of obligations designed to maintain the stability of our markets. So that includes daily segregation statements demonstrating that the FCMs hold customer funds in accordance with our rules, monthly financial statements demonstrating that FCMs are compliant with minimum capital requirements and customer segregation requirements, bi-monthly segregation information reports showing where and how the FCMs actually hold and invest customer funds, and of course, collection of margin. The DSIO's examination branch has staff in New York, Chicago, and Kansas City. And in addition to just being in regular close contact with registrants, they regularly review reports from the FCMs and investigate the required notices that are filed by FCMs related to low capital levels or segregated funds, among other issues. The staff who work closely with the DSROs also conduct examinations to verify that the customer funds are in fact where the registrants say they're being held. So second, I wanted to talk about our coordination with the NFA and CME to make sure that its members are complying with the CEA, the Commission's regulations, and NFA and CME rules. So in recent months, with the introduction of these new virtual currency futures contracts, you've probably seen the NFA has issued investor advisory notices. They've imposed new reporting obligations on CPOs, CTAs, IBs, and certain FCMs. The NFA has also actively monitored its members to better understand who's active in these new contracts and they've taken steps to minimize risk and ensure that market participants understand the risks inherent with these new contracts. And finally, I'll just point out that DSIO has coordinated closely with DMO, DCR, and enforcement to help provide information about our particular area of jurisdiction. We've tried to help kind of fill in the gaps as it relates to the data that we receive and to provide color to Commission staff on what our registrants are reporting to us with these new contracts in the early days. So we've been able to add information either from our own or information we're getting from the NFA that can be overlaid on top of the DMO's exchange information, DCR's clearinghouse information, to help give a little bit more perspective of the clearing member and also to better appreciate the dynamics of what's going on in the market based on the number of CPOs, CTAs, or IBs who are engaged in facilitating trading. And with that, I'd be happy to answer questions after Jamie speaks.
Thank you. Good morning, Mr. Chairman, Commissioner Benham, Commissioner Quintens, Chairwoman Lewis, and members of the Advisory Committee. Thank you for the opportunity to participate today. As Director of Enforcement, I oversee both the enforcement and surveillance functions at the Commission. I'll begin today by offering a bit of an overview about the current structure of the Division of Enforcement, because it's changed over the last year. Then I'll discuss how we approach surveillance in general and what's unique about our surveillance of new products. First, I want to talk just a little bit about the structure of enforcement. Last year, the CFTC moved the Market Surveillance Unit from the Division of Market Oversight into the Division of Enforcement. The CFTC made this move in recognition of the significant overlap between the enforcement and surveillance functions. Here's what I mean when I say significant overlap. The CFTC's mission is to foster open, transparent, competitive, and financially sound markets. In furtherance of this mission, both enforcement and surveillance seek to preserve market integrity and protect market participants. Both enforcement and surveillance do this by seeking to hold wrongdoers accountable and deter future misconduct. They do it together. To hold wrongdoers accountable, we have to identify them, a surveillance function, and we have to successfully bring enforcement actions, an enforcement function. To adequately deter misconduct, market participants tempted by misconduct have to know that they're going to be identified. That's surveillance. And they have to know that they're going to be prosecuted after they're identified. That's enforcement. It makes good sense to me, then, that enforcement and surveillance, that both of those functions will now be housed under the same roof within the Division of Enforcement. We've already enjoyed some of the benefits of this realignment, and I expect that we'll see many more going forward. Now, more specifically, the work of surveillance. The primary work of market surveillance is the same, whether we're talking about a new product or an old one. That work focuses on conducting market surveillance to identify fraud, manipulation, and abusive or disruptive trade practices in our markets. The Market Surveillance Unit does this in a number of ways. First, and most importantly in my view, is human capital. Our Market Surveillance Unit has developed particular expertise across a range of markets and products. As new products are listed, surveillance staff develops additional expertise in those areas. Given the nature of surveillance work, the skill set of our surveillance staff is broad, so the staff can quickly develop expertise in new products. When it comes to new products, depending on the type, we might devote specific surveillance staff to monitoring and surveilling trading in those products. So first is human capital. Second, the Market Surveillance Unit uses data analysis to conduct surveillance and identify misconduct in our markets. This in particular has been a focus for us in the past year. Just a few days ago, we filed a series of manipulation and spoofing cases in conjunction with the Department of Justice and the Federal Bureau of Investigation. We identified some of that alleged misconduct using sophisticated data analysis, using new tools through which we could identify trading patterns that reveal unlawful conduct. I expect going forward, we're going to use this type of data analysis across a range of trading activity to detect various forms of misconduct. Some of this data work can include cross-market analysis and analysis of the underlying cash market to identify efforts to manipulate the derivative contract through trading activity in another market. We can access that data in a number of ways, including pursuant to information sharing agreements the exchange has in place with participants in the other markets. The way we perform this data analysis remains largely consistent, whether we're talking about old products or new. The parameters and the specifics of what we're looking for might be different depending on the product, depending on the market, but the basic tools, the basic data analytical tools are largely the same. Third, our market surveillance unit conducts surveillance by gathering intelligence from the exchanges, from market participants, and from a number of other sources. With any trading product, our staff will be in communication with the exchange, but the communication is much closer and much more frequent with respect to certain types of new products. That's particularly with respect to new products that are likely to have significant trading or that might have initial volatility. When these new products are listed, we'll have an open line of communication with the exchange that's listing that product, and that line of communication is open pre-launch, during initial trading, and during the settlement period. Our pre-launch discussions generally would center around the status and onboarding process for potential market participants, the clearing capabilities and processes, rules in place regarding trading halts, and the process for settlement, including any contingencies. Post-launch, these communications would concern trading activity, including halts, open interest, market positions, and identification of large traders and any hedge exemptions. We would promptly notify the exchange if we identify any surveillance concerns, and we would expect to be notified if the exchange identifies any surveillance concerns. Surveillance in the exchange will also share information around the settlement process. We closely monitor the market during the settlement process. Before, during, and after that settlement, we're going to be in close contact with the exchange to ensure an orderly close. We'll be monitoring, among other things, the positions going into the settlement, how large traders are reducing their positions, whether through rolling over or offsetting, and whether there's convergence between the derivative and cash price at settlement. Finally, Amir on the first panel talked about the core principles. We in surveillance have the ability to require exchanges to demonstrate compliance with their core principle obligations, and if necessary, that's another step that we can take to ensure that everything's running smoothly in the market from a surveillance perspective. Thank you, and I'm happy to answer any questions.
Thank you all. I think the first question that perhaps this raises is what is the relative merit of pre-launch versus post-launch commission review and oversight processes? Is the balance correct, or should it be altered?
I guess I push back a bit at the underlying premise of the question. I mean, I view it much in terms of, I really view it more seamlessly than that. Our work, we did a lot of pre-launch work in the weeks leading up to, more than a month leading up to the self-certification. But our work was not done at that point. As Bill pointed out, we continue to do significant amount of work monitoring of the product. So I see it more as, at least from an internal CFTC perspective, I see it as more of of a piece as opposed to distinct processes. processes. Obviously, there's a time when the launch occurs, but again, the work is not done after the pre-launch activities are concluded. We continue to very much monitor significant introductions of products, and obviously, as a product becomes much more important, some of the benchmark contracts spend a lot of time on those products, essentially a risk, by levels of risks that are presented to the clearinghouse and the clearing system.
And I would just add to Brian, for as much as we've talked about our individual divisions and the components of the regulations that each of us work with, this has been a commission at the staff level. This has been a commission effort across the board. And, it really does take the different perspectives and the different regulatory components that each of us bring to work on something like this, whether it's before, during, or after. And so I know that each of us have presented today sort of how we look at things, but it really isn't done in a vacuum, and none of this has been done in a siloed way. And I think that's really important to remember, that every time one of us has an observation or an obligation, we're sharing that information with each other so that we can kind of get the whole picture.
Paul, the only thing I'd add to that is, though for conversation and analytically we can separate it pre-launch, during the launch, post-launch, I think in practice we view it as a continuing process. From a surveillance standpoint, the launch is incredibly important. It's something that we're going to be monitoring very closely. We're in conversations with the exchanges. We're monitoring the market participants. We're monitoring the launch, and there's a lot of work from the surveillance standpoint that goes into preparation for the launch. So we can talk pre-launch, during the launch, and post-launch, but I understand why we want to have that conversation for purposes, why we want to have those distinctions for purposes of the conversation. But I think what we would say is that from the staff standpoint and from our perspective, it really is one thing leading to the next, making sure that all of the work pre-launch is incorporated into the launch, which then is incorporated into the analysis of the actual trading, which then gets brought into the settlement, which then gets moved over to the next contract period.
I'd like to echo what Matt said. Risk analysis and financial analysis are very intertwined, and so our Chicago risk staff works very closely with the DSIO staff, and even just recently we had a joint review of a clearing firm, and we do that all the time. I mean, that's a regular event, so we work very closely together.
The chair recognizes Kristen Walters.
Thank you. So I guess just to re-ask the question I asked previously, because I noted in your comments that a couple of you noted again that some of your concerns about the product are based on the relatively small size that's currently traded. And that's true, again, so $500 billion to $800 billion in market cap for cryptocurrencies versus an $80 trillion global money stock is very small. So I understand that, but I know from an enforcement perspective, you also, and market surveillance, you also said that your risk process does involve evaluating the underlying risk of the spot markets themselves. So I guess I wanted to ask again, when would you, and recognizing that the statutes are focused on the futures markets themselves, not the underlying, when do you start considering the spot market when you do your surveillance? And just thinking about the fact that, I know there were comments that this instrument is no different than others, but global central banks, the SEC recently, have all taken similar positions relative to crypto assets. So they're highly speculative and they're extremely vulnerable to fraud and manipulation. And there have been explicit warnings to investors about the dangers and risk in investing in these assets. And currently we don't from BlackRock perspective, cryptocurrencies aren't part of any index that we manage assets against, nor they're part of any of our products. And a lot of that is due to the current regulation, but we do recognize that this area is rapidly evolving. Kind of with that backdrop, I again wanted to ask, when does the spot market and the attributes of the underlying assets on which these futures are traded, when does it become relevant, and when is it something that you consider when you think about the product itself and surveillance?
So I'll speak first from an enforcement and surveillance standpoint, and then I'll let my colleagues comment from their perspective to the extent that they've got comments. To begin with, our jurisdiction, so the enforcement jurisdiction, includes jurisdiction for fraud and manipulation of the underlying cash market. And we've brought cases going back to 2015. We brought cases in the virtual currency context. And in the fall of 2017, and then again a couple weeks ago, we brought additional fraud cases in the spot Bitcoin market, in the spot virtual currency market. So from an enforcement standpoint, that's the fraud and manipulation jurisdiction. It falls within the Division of Enforcement. It's something that we're looking at from an enforcement standpoint. From a surveillance standpoint, where you've got a derivatives contract that's settling to something in the underlying spot market, we're going to be looking at the underlying spot market. We're going to be looking at it not to ensure, not to do a comprehensive surveillance and review of the underlying spot market, but we're going to be looking at it because it's part of the settlement process. It's informing the price discovery process in the futures contract. And so what that means is, from surveillance, yes, of course, we start with the futures contract, and we start with evaluating the trading on the futures exchange and the settlement process. But because that settlement process ties in to the underlying, that's something that we'd be looking at.
Yeah, so I understand the fraud and manipulation component of surveillance and enforcement. I guess the other aspect is just the sheer volatility of the underlying asset that's nearly impossible to value. And also from a fraud and manipulation perspective, in the context of cyber and this particular asset, like how do you even identify fraud and manipulation, just given the sheer opaqueness and complexity of the algorithms mining process behind this asset?
So I don't want to talk about any of our particular surveillance tools or enforcement tools, but what I can say is that, to be sure, conducting surveillance of any new product in any new market presents challenges as we make sure that we're equipped and that we have all the capabilities to conduct the adequate surveillance. The features that you're talking about in the virtual currency market are things that we're thinking about. They're things that we're looking at. I just want to be clear, though, that we are looking at it. We're starting from the derivatives contract. We're starting from the futures listing. And so I think a lot of what you've just described, I think you started your question with a discussion about virtual currencies. I think from my perspective, there are a number of follow-on questions that we need to ask before I could provide any specific details about exactly what we're doing from surveillance. But the characteristics of a number of different virtual currencies are different. Some of them are designed to be anonymous, not to be able to identify the underlying owner, not to mention the trader who's trading on a particular exchange. And from a surveillance standpoint, I might view those types of virtual currencies differently from how I'd view virtual currencies that had where we were able to have more insight into the owner of the underlying commodity or asset. And then when you talk about trading activity, a question is going to be, well, can we identify the traders who are trading first on the futures market? And then when we're looking at the futures market, are there particular things in the cash market, particularly in the settlement process, that we need to look at to ensure that the futures contract isn't the price process in the futures contract isn't the product of fraud or manipulation.
Kristen,
yes.
I'm sorry, allow me an opportunity to get in some of the other members.
My apologies.
The chair recognizes Ronna Yared.
Thank you. So my comments this morning are going to center around the question of what work should be done and needs to be done by the applicant prior to submission in order to ensure that the market is ready to receive the positions or the risk once the new contract is launched. So as an institution, we take no issue to the 10-day self-certification. Quite the opposite. We think that it has actually promulgated innovation that otherwise may not have happened. However, as a major clearing member and a mutualizer of the DCOs, we believe that it is critical for the FCMs to be in a position to enthusiastically receive the contracts and positions from our clients and to risk manage them appropriately. Just to give folks context, it is common in the FCM world for the give-up agreements, the contracts that govern the way in which our clients give us their contracts, to not specify product in which we are accepting. And so the launch of the products by both the SIBO and the CME left us in a very interesting position of having to receive contracts from clients that we ourselves had not made a decision as to how we would model, whether we would even trade them ourselves, what would be the risk limits that we would place, etc. And it brings to mind for me the comment that the chairman had started by making, which is, what kind of heightened review can we place such that when the application is made to the CFTC, it suggests that there is already a series of checks that have taken place. And so from the GS point of view, we would want some sort of formal demonstration or attestation or something from the major DCOs when they're launching something truly new and novel that says a significant proportion of the FCMs are, one, enthusiastically ready to take on this contract, but two, believe that the risk management is appropriate and meets the same standards that they have set in their own institutions, and that they're open for business. Otherwise, you're launching a product that clients want to trade, but the FCMs are not ready to take it on for whatever reason.
Harkening back to the chairman's comments, both in Naples and then this morning that he reiterated, I think one of the focuses that he's asked us to undertake in DCR going forward is to look very closely at governance around DCO governance around the launch of new products, and we're undertaking that with enthusiasm and hope to come back to chairman and the commission with our thoughts on that. And I think that goes towards the kind of changes that you're suggesting. I'd be interested myself in hearing both OCC and CME's thoughts on that, since it really, I think, is directed first and foremost at the two clearinghouses.
And that'll be on the third panel.
Okay.
The chair recognizes Jerry Jeske.
Hi, Jerry Jeske for Commodities Market Council. So I hear what the Christian had to say about the big money managers and Rhonda had to say about the large banks. We're a group that participates in the, and I'll use Chairman Giancarlo's comment, stakeholder process. And I think it's a good thing to focus on. And before I get into some of my comments, I'd like to commend staff, both this staff and the prior group, for all the hard work that they have done. I know we're focusing on cryptocurrency, but what I'd like to say is not to lose sight of, I think there was a chart up here a little earlier about the 1,000 different contracts that have been listed over time, and the amount of due diligence that's done, not just from a CFTC staff perspective, but from the exchange's perspective. So to the concept of what has been done by way of due diligence, the FCM community, the end user community, the groups that use these products, not just cryptocurrency, but all the other successful products that have been launched as a risk management tool, is essential. It's essential for good operating markets. And that's what I think the staff deserves to be commended on, the commission deserves to be commended on, and the DCOs. We're focusing on one particular asset. I guess if you call it an asset, I don't know. I can be corrected on that one for sure. We're talking about 1,000 contracts right now in open interest, compared to, for example, the loop storage contract for oil, which is a relatively new contract, has 20,000 open interest. Very successful risk management tool. I think we need to be careful about what we ask for by way of the self-certification process being criticized or otherwise made more formal, because again, the end user process, the ability to interact with the exchanges in a commercial management is essential. And that is done on many, many occasions and is a never-ending process, unfortunately. So certainly I appreciate the position of the FCMs and their clients. We happen to be clients of a few FCMs, and there should be interaction there, certainly. But those organizations need to take that upon themselves to interact with their constituents. And certainly the exchanges do that in many, many, many of these products that have been successfully launched. And then looking at comparatively other asset classes such as electricity and power, and the stakeholder process associated with RTOs and ISOs is nowhere close to what the Commission enjoys and what the commodities market enjoys. Likewise, in Europe, ICE Futures EU just launched 37 contracts in mid-January. The process associated with launching contracts is a never-ending one. But everybody wants the next Treasury bond contract, of course. So there's natural competition, which is a good thing. And I would say on behalf of the CMC that we are ones that enjoy seeing competition, not just from an FCM perspective, but obviously from exchanges, other exchanges introducing contracts, forced innovation, and I think that's just a very positive thing. So thank you all for your time and effort in this process.
The chair recognizes Kathleen Cronin.
One of the points that has been made several times is concerns about the volatility of the underlying market. We list a lot of contracts on markets that have underlying volatility, and in fact, we consider that to be important in terms of when we think about listing a contract. Our purpose is to allow people to manage their risk. And to the extent that an underlying market has some degree of volatility, a futures contract has significant value in allowing people to manage that risk. And we have in place, in terms of ensuring the integrity of the futures market, first, we go through a robust process when we decide to list a new contract to ensure that it meets all the criteria necessary so we're in compliance with our core principles. And some of that includes, the liquidity in the underlying market, the ability for price discovery in the underlying market, and most importantly, how we construct our index and whether that's a fair representation of what is going on in the market. So it can take into account anomalies in terms of pricing. And given that we have 4 exchanges that we get data from, we feel like it presents a broad cross-section of the underlying market. Then once we've looked at that and the construction of the index and are happy with that, we go through our usual process of setting the margin, which again is subject to adjustment over time. And that's only the beginning of our risk management controls, because we have a number of other controls in place, which include trading halts and circuit breakers, which are mechanisms in our market to help minimize volatility. And we have other protections as well in terms of credit controls and a number of different mechanisms to manage the risk. So we're quite comfortable that the risk profile of this contract is no different than the risk profile of many other contracts that we offer, and that we're able to effectively margin it and account for that potential risk.
The chair recognizes Biswar Chatterjee.
First of all, I'd like to thank DCR. I think it was very commendable, and I think very happy to hear that the amount of due diligence that went behind into applying the historic data and looking at the adequacy, not only trying to achieve 99, but like you said, almost 100% coverage. Going back to I think a couple of MRAC meetings where this committee focused a lot on the safety and soundness beyond, and the resources beyond the initial margin, which is, the rest of the waterfall, skin in the game, funded and unfunded contributions. Recognizing how complex clearinghouses and the clearing landscape has become, multiple products, futures, OTC swaps, some exchange traded, some OTC traded. Where do you think, and this is for the panel as well as the rest of the committee, where does, in the new product, or more importantly in the ongoing monitoring, does consideration come into the rest of the resources and the sensitivity that a new product may expose risks to the subsequent areas of the waterfall,
obviously IM is the first line of defense, and we get that right, we're never testing the rest of the waterfall. But at what point should, the consideration be given to ensure that the new product, either launch or ongoing monitoring, doesn't open up, that risk? Or to maybe what my colleague from Goldman Sachs mentioned, should be that part of the initial disclosure that the clearinghouses have to give to the marketplace, that they've looked at these considerations?
I think a part of that is the stress testing that we do and that we expect the DCOs to do. And as Bill, I think, mentioned in his opening remarks, we are using very extreme shocks in this circumstances. We're looking at 100% moves, both up and down. So the possibility that the Bitcoin goes to zero in a day in doing our analysis. So I think that's a first line of dealing with that, is looking at very extreme shocks when we're doing stress testing. And again, we would expect the DCOs to be doing similar types of stress testing, and that'll be a focus of examination work that we do going forward. I don't know if you have something to add, Bill.
All right. We looked at the same thing pre-launch as well. What effect the new product would have. We created some hypothetical portfolios. We stress test those as well, and we wanted to see potentially what effect these new products would have on the waterfall, and we did that same type of analysis. So both pre and post-launch, we use stress testing to see what the effect could be of these products. And to date, we haven't had any concerns. But as open interest grows, we'll continue doing this analysis.
I think as a follow-up to that question, one question is whether or not the exchanges and clearinghouses have incentives that have changed over time, and if so, how have those changed incentives affected the Commission's work, and has the Commission taken that into account in the processes that it uses either pre or post-launch for new products?
Yeah, sure. I think so. My work both at the SEC running the clearing program and over here has been in this new era that we're in, and so from my perspective, I mean, we take the risks that are taken on by DCOs very seriously, both pre-launch and post-launch, and we will continue to do so. I just don't have the historical perspective that goes back to the mutualized days of CME back many years before I was in the regulation business. But again, I think the message both on the first panel and the second panel with Bill and me has been that we take risk very seriously. The DCOs engage in dialogue both before launch and after launch. It's ongoing and very serious work that is done by the staff in DCR.
The chair recognizes Marcus Stanley.
Yeah, this is just a question that goes to some of the general issues about the surveillance of the margin models and stress testing, and also some of the things I think Kathleen said about CME's work in terms of setting margin. The press has reported that CME initially proposed a margin of 27% for Bitcoin derivatives. Then it was increased to 35% following discussion with the CFTC, and then rather rapidly after introduction, it increased to 47%. And I was. Is that driven just kind of by? I mean, was that expected in terms of this kind of very sharp change in margin, and could those kind of sharp changes create some general market risk if this was a product that frankly was larger? And does that change say anything about the margin models themselves, which you said didn't have to be changed or altered for this product, or was it just a level of volatility in the underlying that was unexpected?
So when they when they came in first to talk to us, they always speak in ranges when they're starting out the process, so they don't give a definitive number. And they actually came in, and this is CME specifically, they came in with a range that on the low end was 27, and the high end was in the mid 30s. We engaged in discussion with them. We did back testing. Back testing at the 27% number, and that met our standards of 99% confidence level. We did have discussions at various levels in the commission with CME about that, and as well, there was obviously a lot of market discussion about the product, and as well, if you'll recall, it seems already in the distant past, in the weeks and months leading up to the launch of the product, particularly those weeks in October and November, there was significant volatility on the upside. That seems to be well in the past, at least as of 2018. And I think those all contributed to a decision for CME first to come in at the high end of the range that they were proposing, the 35%. And then that was the number that they were telling us at the time of the certification. And then I think that high end volatility came in, it continued up to the actual launch, and for their own business reasons, they decided to move it up to into the 40s from 35%. But again, these numbers, even if they had stayed at the 27% level, it would have been within the confidence requirements of our regulations. So this is well beyond what the requirements are, and you see that in the margin erosion work that we do on a daily basis, looking at how much the margin erodes based on market moves since launch, and in comparison with a lot of the major products that are traded on the major futures exchanges, the margin erosion is not at the high end of what we see for some products. I don't know, Bill, do you have?
The chair recognizes. I'm sorry, Bill.
I was just going to say that I just think it shows that the increases in the margin requirement just show their responsiveness, quick responsiveness to changes in volatility. I think it just shows that they're very responsive.
The chair recognizes Dale Michaels.
And maybe give a little bit more insight from a clearinghouse perspective about the different margin levels. We look at it from a 2-year history at OCC. So when we first started looking at Bitcoin in the June timeframe, when we had the price history of 2 years, we looked at the margins, and they were in the mid 30% range based on our model, and I'll go into that more into the third panel. But that's a point in time. Every day we add a day, we drop a day. We add a day, we drop a day. The volatility, as volatility is increasing, the margins will increase with it, or if the volatility is decreasing, the margins will generally decrease. So anything you would have seen beforehand would have just been a snapshot in time. So as the launch got closer and we went to a December launch, at that point in time, with a little bit more volatility in the Octanove timeframes, you saw that the margins were upwards of 40%. That's just reflective of the margin models doing what they do and taking in the more current history, dropping the older history to be reflective of the current market conditions. The other point that I want to make is on stress testing. This is also something that was brought into the governance, something that was reviewed by the CFTC as well. So when we're having discussions with our risk committees, we're having discussions with the clearing members, which we meet with on a periodic basis in a formal process at the OCC. We discuss what the margins are and what the stress testing is going to be. We provide the data of what we're going to use for our clearing fund, whether the clearing fund needs to have any other changes, the stress test we're going to be using, and provide that information in discussions with the CFTC, as well as, of course, our risk committee when we reviewed this. So It's not just margin is the first defense, but that's not the only thing. We're also looking at the items of stress testing and other items as well that I'll talk about as I foreshadow the third committee.
We'll take 2 final questions, and then we'll break for lunch. The chair recognizes Kathleen Cronin.
I think that Mr. Busse did a good job of summarizing the process where CME increased its margin, so I won't repeat that. I will just observe that we were intentionally very conservative in terms of setting the margin for this product, understanding public perceptions and concerns, but quite comfortable that we've provided for more than adequate margin to address the risk of the product. I'll also just briefly address the implication from Paul's question about changing incentives for the exchange and the clearinghouse as we become public. And I think that's been discussed many, many times over the years since we became public. And, our obligations with respect to risk management have not changed. Our obligations with respect to compliance with the core principles have not changed. And so the fact that we're a public company, if anything, makes us more responsive to customer needs for risk management products, but it does not change our approach to ensuring the integrity of our clearinghouse.
The chair recognizes Marnie Rosenberg.
Thank you. So I sit within the risk management division of JP Morgan, and we did a deep dive targeted review, as CME and OCC both know, because I've spent a lot of time with both organizations. And the question I have is, how much does the CFTC staff engage with the FCMs that do bear ultimately through the default fund and the assessments, the risk? If a product were initially at launch, products may have low volumes, small open interest, but it's really hard to gauge at the outset how much that grows. So I would be interested in understanding how much the staff engages with the reviews or consults with market participants in terms of work that they've done on some of these, some new products.
So I'd answer in sort of, there's 2 tracks, right? So the first is the regular ongoing regulatory oversight. So looking at levels, looking at capital, looking at seg, looking at residual interest, making sure that the cushion that's required to be there is there. Then the second piece is really more of the call it sort of anecdotal, where we reach out and we talk regularly with the FCMs, particularly on a new contract, right? When these contracts were launched, we were almost constantly in touch with either the NFA, the CME, or specific FCMs. And it was helpful to hear from them about how they were engaging with their customers, how they were deciding whether and how to facilitate trading or allow trading for their members, whether they were setting margin levels higher, if they were implementing any sort of trade size restriction. And anecdotally, they were very conservative in this instance about how they approached that in terms of who they let in and who they didn't, and also how they made sure that they had the adequate protections in place in the case of extreme volatility on the futures contract. And so, we both kind of had the quantitative and the qualitative data that we needed, combined with the information from the exchanges and from the clearinghouses that our colleagues had, to get a better sense of what was happening at the FCM level.
Paul, anything? Okay. So at this time, in keeping with the agenda, we will break for lunch. Let's see, it's 12:34 now. So we will start again at 1:35. Please note, there's a list of area restaurants on the agenda table. Should you wish to bring back your lunch, you may eat in the employee lounge, which is right around the corner from this room. And also, to commemorate the first MRAC of 2018, Bob Wasserman has baked 2 of his famous cakes. So as an incentive to return just a little early, we will be putting out the Wasser cakes at 1:20. You don't want to miss them, so thank you.
1, 2. Oh, I'm muted the whole.
Open for a reason or just? Test mic one. Nope. Test mic one. Test mic one. Test mic one. Lewis, CFTC. Lewis, CFTC. Lewis, CFTC. Roston Benham, CFTC. Roston, CFTC. Roston, CFTC. Roston, CFTC. Christopher, CFTC. Christopher, CFTC. Christopher, CFTC. Okay. Mic open. Lewis, CFTC. Lewis, CFTC. Lewis, CFTC. Lewis, Lewis, CFTC. Lewis, CFTC. Christopher, CFTC. Christopher, CFTC. Christopher, CFTC. What, every mic?
Every other mic coming up. Yeah.
Okay. All right.
It should only allow you to have 4 at a time. Yeah. Good. Good. Record. Yeah, so that's already something. Yeah, exactly. So you want to do it, you turn those down, you do these other, on every other one, and then speak? Because that's what he's trying to see.
Do you want to do every other one and try speaking?
Well, that was Chad. Yeah. Yeah, that would be. No, yeah, it's Chad. Yeah, right. Exactly what Chad said. Yeah, you're good.
All right.
So we'll turn these 2 off so we can turn the other ones on. Yeah.
Got
You
it.
gotta turn something off.
So hopscotch, what you doing? Yeah, exactly.
Bang, bang. Bang, bang. And I really want his mic on, but
it's really this guy. That's 2.
Oh, my fault. Thank you. But now that we have Chad, I'm going to talk for you. Let me know if you get any feedback, sir. This is the trouble mic. This is the trouble mic. Trouble mic, trouble mic, 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 trouble, mic, mic, trouble, mic. Mic, 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 mic. Test, test, 1, 2, 1, 2, 3, 4, 5, 6, 7, 8, 9.
Could everyone please take their seats? We're going to begin shortly. Could everyone please take their seats? It's my pleasure to call the meeting back to order. I hope everyone is enjoying the Wasser cakes that are in the back. And now we will have the third panel of the day, Futures Exchanges and New Products. And I'll turn it over to Paul Archesell.
So thanks very much. Let me introduce the panel. I think each panelist will be making a statement, and then we'll have an opportunity for discussion by the committee. So on the panel today, we have Julie Winkler from the CME Group, Chris Concanen, President and Chief Operating Officer of Cboe Global Markets, Tribute Bland, who is with ICE Futures US, and Dale Michaels, Executive Vice President of Financial Risk Management at the OCC. So with that, let me turn it over to Julie, and please start.
Thank you. Good afternoon, Commissioners, Mr. Chairman. My name is Julie Winkler, and I am CME Group's Chief Commercial Officer, where my duties include managing our research and product development team, as well as our digitization and sales functions. Thank you for the opportunity to participate today to discuss self-certification and the initial listing and clearing of commission-regulated contracts. We think it is important for the Commission to continually examine and assess existing processes to help in its mission that regulated markets operate in a transparent and efficient manner. Exchanges can list new futures by requesting Commission approval or by certifying that the contract terms comply with all applicable CFTC regulations. The new product process is collaborative and deliberative, whether the exchange takes the route of prior CFTC approval or self-certification. The CFTC's role in either case is significant and substantive. Exchanges make sure that the exchange's staff is briefed on planned new products with unique contract design or regulatory elements so that the staff may identify any concerns. The Commission staff has great experience in this area. Its views are valued highly by the exchanges. And this consultation process occurs within any planned new products with unique contract design or regulatory elements. Today, I would also like to share some information about how CME Group approaches the product development process, that is the work we do prior to listing or clearing a product. At CME Group, we view the product development process as a mechanism for capturing, communicating, and filtering product ideas with the objective of bringing commercially viable and regulatory compliant contracts to market. At the ideation stage, we conduct analysis to determine whether there is a unique client need for a new product, and we evaluate both the structure and the trends of the underlying market. We also consider whether the market has an accepted benchmark that can serve as a contract's reference price, and if not, whether an available pricing data can support a new derivatives contract. After the ideation phase, this leads into product feasibility review stage, during which CME Group initially interacts with key market participants for the purpose of identifying contract terms and conditions. The product feasibility stage is followed by even more customer validation. At this stage, we solicit customer feedback broadly to assess whether a product's proposed terms meet the demands of a variety of market participants. The interaction with the market participants ensures that the product's design captures cash market convention. Another important component to the listing of the product is the ability to conduct risk management around that product. CME Group's internal risk management process is complementary to the product development process that I previously described. CME Group's clearinghouse staff has vast experience in evaluating the risk profile of new products. In determining product risk profiles, CME Group's clearinghouse staff will review a product such as Bitcoin reference rate futures with the relevant exchange business, product development, and operations teams, and they provide a comprehensive view on risk management issues. Another essential component of our product launch process is ensuring that the product can be effectively monitored and surveilled. For instance, prior to a product being launched, CME Group's Market Regulation Department works with the relevant product development, business, operations, and clearinghouse teams to ensure that the new product reflects common cash market practices and meets CFTC core principles regarding susceptibility to manipulation. Our Market Regulation Department also works with CME Group product development staff to perform a deliverable supply analysis and establish position limits and/or accountability levels for a new product. These limits and/or levels give market regulation the ability to limit corner and squeezes, particularly during the expiration of the contract. Additionally, they give market regulation the flexibility to monitor and dialogue with larger participants surrounding their positions and trading strategies. Moreover, in addition to position limits, market regulation has a combination of tools to assist with its surveillance of the markets, including reportable levels, existing trade practice reviews, and market research reviews to deter and detect any activity that have the potential to violate our rules. Although some aspects of the above process are commercial, CME Group's product review procedures are specifically structured to satisfy statutory obligations as mandated by the Commodity Exchange Act and Commission's regulations. For example, the procedures above are directly shaped by our statutory obligations, including the limited authority to list for trading only contracts that are not readily susceptible to manipulation and that reflect cash market conventions. CME Group will consider bringing a new product to market only if it successfully navigates through these stages, the review, and these procedures. I look forward to today's discussion and welcome any comments or questions from the Commission as well as the committee. Thank you.
Mr. Chairman, Commissioners, committee members, and guests, I'm Chris Concannon, President and COO of Cboe Global Markets. I'd like to thank the committee for inviting me to participate today. I also commend the committee for its willingness to review aspects of our market, including the self-certification process. Cboe is a leader in providing global investors with cutting-edge trading and investment solutions. In addition to our futures exchange CFE, Cboe operates 6 national securities exchanges consisting of 4 options exchanges, including the largest U.S. options exchange, and 4 equity markets, comprising the second largest U.S. stock exchange operator. Cboe also operates the largest European stock exchange and a foreign exchange platform. We offer the industry's widest array of products, including securities options, futures, equities, ETFs, FX, and proprietary index products such as futures and security options on the Cboe Volatility Index, or VIX. Obviously, our most recent futures offering is a Bitcoin futures product that has drawn some attention. Not much, but some. Product innovation is what Cboe is all about. We engage in the process across multiple asset classes, and it is a function and responsibility that we take seriously. Bringing a new financial product to market is complicated, and it is a deliberate process. In most instances, our first engagement is with our customers and our liquidity providers to assess the interest and the viability of the product. Oftentimes, during this process, we receive sufficient feedback and perform sufficient analysis to determine to not move forward with a product idea. For products that make it past this stage, we routinely engage our regulators to discuss potential benefits and/or concerns around the products, including any impact to investors and the marketplace. For futures products, this all takes place before the self-certification process is initiated. Thus, self-certification is the last piece in a long series of pieces that are involved in bringing a new futures product to market. In terms of self-certification process itself, Cboe is quite comfortable that is a suitable mechanism to facilitate the introduction of new futures products, and that it has served investors and the industry well since its introduction in 2001. We understand that the introduction of a Bitcoin futures contract drew great attention. However, the self-certification process worked exactly as intended. We applaud the Commission for sticking to the thoughtful regulatory framework it has designed for the introduction of new products. It is important to note that many of the concerns that were raised around Bitcoin futures really had very little to do with self-certification. There was nothing about the CFE launch that caught parties by surprise. The prospective product launch was covered extensively in the press and discussed considerably with and by industry participants. We believe that the diligence that was put into the product's development and introduction was reflected by its successful launch. I thank you for the opportunity to participate and look forward to the discussion and any questions you may have.
I'm Dale Michaels from the Options Clearing Corp. First, I applaud the Commission for putting this panel and this discussion together, especially to bring the transparency to the light of all the governance process that we've gone through at OCC with Bitcoin. I'm going to take a little bit different perspective from the exchanges. With the Options Clearing Corp, I'm taking it from a clearinghouse perspective. I run the risk management area and want to give you a little bit of insight into the overall process that we go through for a new product. First, the Options Clearing Corp. We are the clearer for all equity options in the U.S., both broad-based indices and single names. We also clear futures for CBOE futures, NASDAQ futures. We know a little bit about volatility with much of our single name risk and options on those. With any new product, what we look for is the risk management aspects around the product. What can we put in there to make sure that we have the proper controls in place? With a new product, we're looking at, is there anything new or novel about a product that we're bringing? Is it just an extension of existing product, which we see a lot of the energy products, or is this something, a new asset class? If it is something that's been deemed as new or novel, it goes through an internal and external governance process on the risk management surrounding those products. So I'm going to give you a little bit of insight into the Bitcoin. With our margin model at OCC, we use a STANS margin model. The CFTC noted earlier today there is a minimum of a one-day period of risk for margins. At OCC, we employ a two-day period of risk for margins, even a more conservative standard than the minimums. We also have an expected shortfall model. What that means is that rather than just looking at a 99% VAR type of model, looking at all observations and just cutting it off at 99%, we look at all the tail risk. So we look at 99% all the way to 100% and average out those, and we're coming up with our 99% coverage levels. It is another more conservative type of risk management that we employ at OCC and what we're employing today for Bitcoin. When we looked at the margin model and the volatility of the product, what we did is looked at least 2 years of data when we started off and did back testing to ensure that our margin model can support the product. When we looked at the back testing, did we cover 99% at a minimum based on our standards of two-day margin period of risk and our expected shortfall method? We found that it did and did so very routinely. We then went back and said, well, 2 years might not be indicative of all the market's volatility that we've seen. So we went back in time and went to even further stress periods of Bitcoins than what we've seen even recently. We went back to 2013 and stressed our model back then and see, could we cover that type of volatility? We did exceed a 99% coverage on that piece of it as well. We then went further, and beyond the historical stress periods, we also looked and shared this information with our risk committees. This is something that we do on with any type of novel or new products as well, and I'll get to that a bit more in a bit. But this is, part of when we looked at the initial margin, how we got first comfortable with the fact that we had the first line of defense of the initial margin. And we're doing daily variation, of course, with any of the market moves. So we're doing a daily variation, but we're covering a two-day margin of period of risk. So we're taking the risk off the table each day. We also then looked at the stress testing of the products. what is it that we need to incorporate for our clearing fund? We have our margin model came out with about a 40% or so, a little bit above these days on a daily basis, since we do calculate this on a daily basis, as I mentioned earlier. Every new day comes in, we have a fresh volatility, we drop an old day. We looked at the stress testing and looked at how that might employ into our clearing fund. And would that coexist with all the products that we have there? And what type of stress testing parameters would we need to have with our clearing fund for these Bitcoin products? So we are stressing well over 100% going to the upside, nearly down to zero on the downside. And then we looked at how this fits into the product set that we clear. Should this be in the single fund that we clear? And this is another type of discussion that we have with our risk committee. I also looked at the pricing of the products. Where are we getting the prices? What are the backups of the prices that we're seeing? What are the limits and other pricing structures in place? So that if there is an issue with the primary pricing source, do we have other sources of prices that we can get? That's what we track. We continue to track to make sure that the pricing is consistent. One thing to note is that since the Bitcoin markets have launched at both CME and CBOE, and looking at other venues where we see prices, the correlations have increased, meaning that as we've seen more transparency being brought to the market by the clearing of these, we're seeing better price information out in the markets. We also look at the default management capabilities that we can employ with these products. Who's going to be clearing these products? Who are the market makers? Who can we talk to if we do have a problem on if a clearing member does default and has these products in their portfolio? So we have ex ante an idea about where to go with these types of products if there is a default. Overseeing all of this is the risk committee of our board. Our risk committee involves the clearing members that are clearing this product along with independents, and it's a subset of our board of directors. They started looking at this back in July of this past year, looking at the same type of things I brought out here earlier. They were looking at the margin model. They were looking at the back testing. They were looking at the stress testing. They were looking at the clearing fund. They had particular interest in the pricing. This was not just one conversation, but multiple conversations with our risk committee to get everyone involved and understanding of the risk management and improving the risk management that we had around this product. Since the time that we have launched the product, we've gone through an expiration, a seamless expiration in January of the product. As I mentioned, we've seen volume and open interest both increasing at the CBOE and at the CME. And we have seen consistent pricing. We've seen higher correlations in the pricing. So all in all, a very good first couple of months. And I should also mention, as I mentioned earlier in the panel, when we talked to the risk committee, this information was shared with the CFTC. They were asking on the CFTC and at the SEC, since they are also our primary regulator at the OCC, on the risk management surrounding the Bitcoin products. So all this back testing I talked about, the stress testing, the back testing going to more stressed periods was all shared with the CFTC. Numerous types of discussions with both the CFTC staff and their more quantitative focused staff, so they can understand what we were doing on the stance margin model, on the back testing and the stress testing and default management around all of this. Thank you.
Hi, I'm Tribune Bland. I'm president of ICE Futures US. We don't actually have a Bitcoin contract, but we do follow all the processes and procedures that my colleagues here at the panel just discussed. So I'm not going to add to what they said. I look forward to your questions, and thank you for inviting us.
Thank you. I think perhaps the place to start the conversation in this segment of the MRAC meeting is around processes for stakeholder input. To the extent that the Commission's process does not involve public comment and does not really have an opportunity for public participation, to what extent do the exchanges and the clearinghouses have a process or provide for not only input from their risk committees, but also their larger stakeholder audiences?
Well, I'll start. This process, I would say, was quite lengthy for us. We spent about a year before the launch. So over a year ago, we started looking at the asset class that we call crypto. We had spent a number of months with many of the participants in that market. Most of our market makers on our futures exchange were already dealers in the crypto market. So it was our clients that came to us asking for a derivative contract that they could use. So it was a solution created by clients at the outset of the discussions. We obviously had a lot of internal analysis of the product and the underlying asset class. And then we moved into what we called the client interface phase. Now, we decided because of the nature of this product that we needed to announce our interest in the contract because we are a public company and it could have clearly material impact on stock prices. So we announced our interest in launching a Bitcoin future contract, and that's when we were able to more formally engage our clients and our FCMs that clear the product. So it was a lengthy conversation. In fact, the current construct of our product changed as a result of that interaction, not only with our clients at first, but then interactions with the CFTC staff. So we viewed this as a very formal process from the very beginning. And as a market, to just surprise your clients and your market makers, your liquidity providers with a new product is a detriment to the launch of that product. It's just not recommended from a commercial standpoint, putting aside your obligations as an exchange. So I viewed it as quite a lengthy process, and the product that we designed and ultimately put in front of the commission benefited from that interaction, and it was months of interaction.
Similar to the comments Chris was making, I mean, we at the CME were looking at this product for over 2 years. Our first conversation with the commission about the index creation dates back to May of 2016, and the underlying index, which is the reference rate for our contract, was launched in November of 2016. So the index itself had been out there for over a year, and having that be out there, then it became a great vehicle for us to solicit feedback from clients, because again, our intention was, can we create a robust benchmark that follows IOSCO principles, that can be used, that is not readily susceptible to manipulation, and is indicative of the cash market and trading activity. And so throughout that year that we had the index out there, many conversations, in fact, hundreds of conversations and in-depth meetings with clients about this, similar to CBOE, that helped us to modify and create the contract that we ultimately launched. That was done in feedback from clients and firms. Many conversation with clearing member firms as well. There's obviously some unique aspects of this, and we believed that that was an important part of the process to, solicit their input. But that is how we design all of our new products. Client validation and the need that clients have for that product is the single biggest driver for why we introduce things.
Sorry. We self-certified 163 contracts last year. Every contract went before our risk committee and I clear at 2 different clearinghouses, ICE Clear Europe and ICE Clear US. And it also went before the boards of both the clearinghouse and the exchange. Even before we hit that, just like everyone else, if you don't have people who are going to trade the products, there's no reason to take it through that process. So we do extensive market analysis before we get to that, and which you can see a lot of times when we file it with the CFTC. It's a very extensive filing even for self-certification.
And take it from the clearing perspective, at OCC, we do a couple things. I talked a little bit about our risk committee that has an overview of these types of novel products. We also have a financial risk advisory group at the OCC, which is consisting of clearing member firms, buy side, and exchanges. That when we come up with either model changes or governance changes or novel new products, that we bring this to get comments. That's those comments are brought in front of our risk committee to see if they are worth bringing into the process. So, for example, we did a recovery and wind down process, got many comments back, brought it up through a risk committee, made some changes into our overall process. So this is a committee that we solicit opinion. It goes to the proper governance bodies within OCC and can make changes to the end results.
So again, this may be something that the committee members may have views on, but a follow-up question would be, is there a role for the commission with regard to the structure and formality of stakeholder validation for new products before they're submitted to the commission for self-certification?
I think the obligation sits with the exchanges to present some of the feedback that we've received during our process prior to self-certification. And in fact, that's some of the dialogue that we had with the staff. They want to know, how did you come to this result, the product design? So there is feedback coming into the CFTC as a result of our collective processes prior to submitting that self-certification form.
I think the process right now works very well. The CFTC staff is and I know this from dealing with multiple different regulators, is the best, bar none. And this might be me as a former CFTC employee, so I might be a little bit biased. But they're very, very good. They look at these contracts when they come in, and we do have discussions before, and they're always great questions about whether we've thought it through. And so I think the process works very, very well, but that gives us the flexibility to innovate.
And just to add on one final answer, I mean, there was a question that the CFTC explicitly stated to us, what was the feedback that we solicited from the community? And that's where you could go in and say, we did have a financial risk advisory council that we solicit this type of feedback. We do meet with members, and many members around this table at the MREC reached out and with their credit counterparts within their different firms to ask questions, in which we certainly will give any time to. We also have talked to the futures organizations to make sure that they are aware of the risk management aspects around the product.
It's been reported in the press that there has been some suggestion that perhaps certain types of contracts should be subject to a separate clearing fund. And I guess the question is, what thought has been given to that? Whether stakeholders who are clearing members think it's a good idea to have separate clearing funds, and if so, when would you have a separate clearing fund, and how would that process look?
I'll take this to start off with, since it seems right up my alley. This was actually an explicit conversation at the OCC Risk Committee. The idea of a separate clearing fund for novel or new products. With the launch, we decided to go with a single clearing fund for a variety of reasons. We looked at the volatility of the product, the margining around it. The volatility was certainly consistent with some of the products that we clear now. We looked at the cost of separate clearing funds and the impact to the additional cost of the clearing funds to the clearing members themselves. So if you start breaking apart clearing funds, you are increasing costs because you lose a diversification risk by having the one single clearing fund. So if I start breaking out single name equities versus index equities versus futures, I'm going to have to come up with the worst loss projections for each of those clearing funds. that my clearing fund aggregate amounts will be greater than the single clearing fund amounts. That has capital implications for each of our clearing members because they're often calling me quite frequently about the capital implications of the clearing fund and the overall cost. So if we start breaking apart, it's going to be increasing the cost to the industry, increasing the cost of the clearing members. That was a strong consideration that we looked at when considering whether to break apart into separate clearing funds.
From CME's perspective, very similar to what was done at OCC, there was, a lot of analysis done around the risk profile of these contracts. And while the volatility can look significant when we put it in light of other things that we have cleared in terms of electricity contracts or even emerging market currencies, those are actually more volatile than what we've seen with the Bitcoin futures contract. And so, we feel confident that the risk management we have around that, the margin that we are collecting, so at 43% of notional, our typical range for other, similar type commodities in the range of 1.5 to 4.6%. With Bitcoin futures, we're over 40%. And at a percentage of, the base initial margin, we're collecting about 59 million for Bitcoin futures today. That's off of 90 billion in the overall fund for base margin. So again, that's 0.7%. We think this is definitely covering the risk. It certainly was discussed, but from all the characteristics, the fact that we had 5 years of back-tested data that we were able to analyze, we felt confident that we were going to be able, and again, this is a futures contract based on an index, a cash-settled product that we handle hundreds of other products very similar.
The chair recognizes Rana Yared.
Thank you. So this is a question, I think, mostly to the OCC and the CME because you run your own clearinghouses. Where does the tipping point occur in your mind where you do require a separate clearing fund? So, Dale, I appreciate your comment about splitting out single name from indices, and frankly, no one would ever suggest you do that because we think of the equities class as an asset class vertical, right? So you wouldn't want to split up the correlated component parts. But we also have grown up in businesses, for those of us who have spent a lot of time in FIC, where active decisions were made by, for example, by the CME to put interest rate swaps separately from the futures and options pool, where the LCH does the same with interest rates and FX, and where ICE does the same with CDS. And maybe we can say that they made that decision because at the point at which they started clearing, there was a very active market in that product, and they were able to size enough to say that should something go wrong in this product, we'd want to isolate it away from the more vanilla F&O pool. Appreciate that the Bitcoin futures don't start with that wall of open interest, so to speak, behind them. But what is the criteria in your mind to make the decision to break it out versus not?
When you looked at and compared versus the CME, you had exchange traded derivatives in one class, and then OTC interest rate swaps and OTC credit default swaps. There seemed to be a very bright line when those types of decisions were made. I mean, over the counter, there wasn't a front end trading engines at the time that the interest rate swaps were going. Same thing with credit default swaps at the time when the clearing had started. There was different considerations on the margin period risk, looking at 5 days periods of risk in interest rate swaps and credit default swaps versus a minimum of 1 day in the futures. So it seemed to be, to try to cram that into one pool, seemed to be inconsistent. They have different risk management. They have different default management practices. The default management for OTC and credit default swaps are required participation by each of the clearing members. That does not happen on the future side or the option side in exchange traded derivatives. So it is those types of considerations as far as what is the ultimate thing is, what are you doing for default management? What are you that's really what when you start looking at the clearing fund, do I need different default management practices? That would likely get you into a world of, I need a different clearing fund. When we looked at Bitcoin and looked at default management that we would employ for an exchange traded derivative, that's where it much leaned heavier towards keeping it in the same fund.
I think, yeah, I would echo what Dale said. I think it is about default management is just very different. Here we're talking about a cash settled instrument. We have reportable levels of one contract. Our clearinghouse knows every single person that's holding a position. We're in a position where clearing firms have the ability to use inline credit controls and, disable down to the account level. And so, their ability, as well as the clearinghouse's ability to quickly liquidate positions that, would be a concern, as well as that 2-day, margin coverage, makes it, again, appear so much more similar to all of the other futures contracts that we clear today and does not have those same risk characteristics of CDS and some of the other things you mentioned.
With regard to futures, would there be any novel contracts that you would think should be split out into a separate guarantee fund?
Very open-ended question. I would have to look at the contract specs. It would have to be, would be able to do default management on it, would be able to price it, can I risk manage it in the same way that I do the rest of the exchange traded derivatives? So I don't think I could answer that question without more data in pricing and how things are settled, how things, if it's cash settled versus delivered, is it traded on a exchange traded platform, or am I getting it over the counter? Those are the types of questions I'd have to put forward, and it's all about can I liquidate these products in the same way that I can liquidate exchange traded derivatives? Because when I have a default, I'm going to through an auction process for a big portfolio, and is there anything different about these products that I have to think about separately than I do for my other products?
The clearing members are our partners, and if they ask us to come up with a separate guarantee fund, and they're going to support that, and we think that the additional cost and expense of creating a separate guarantee fund is worthy of creating this new product, then that's we'll do it. I mean, it really comes down to what the clearing members want to do. That's why we separated out CDS into a separate clearinghouse.
The chair recognizes Thomas Coyle.
Thank you. I'm curious about convergence. I see the CME and their longstanding contracts and the process they go through to review the contracts, to check the data to make sure there's convergence. I'm curious on the newer products. Two questions. Are there different metrics you use, different processes you make on a new contract to make sure there is convergence between the underlying and the contract itself? And second of all, when you're cash settling a contract against an index, is there any analysis done within the index itself to see if there's any anomalies within the index that may skew, the settlement?
Thanks for the question, Tom. I would say there are some differences between how, the review of a physically delivered contract works and how an index-based cash-settled product works. In the case of, the Bitcoin futures, our market surveillance team is watching that index every single day. We are getting all of the constituent data for that reference price, and the reference price is published every single day at 4 p.m. London time. And that is our time to look for where there may be anomalies, where there may be, a large trade or something that came in from one particular constituent exchange. Our index methodology is published, and in doing so, we make it very clear when and what types of trades we will include as part of that reference price. Part of this for us too is just making sure that while we are using 4 different constituent exchanges currently for that reference rate, there's obviously hundreds of other spot platforms out there today. So part of the role of market surveillance, and I know the CFTC is doing this as well among their staff, is monitoring what else is going on on those other platforms and taking all of that information and data into account. So it's very similar to what we would do today with our energy products, where maybe we use one particular PRA as the settlement price for that particular contract, but there's another, competing PRA that also offers it. we're constantly triangulating that data to ensure that we do have price convergence. And I think it was Dale that had mentioned it earlier. We are starting to see, now that we've been, almost 2 months into the launch, a narrowing basis between the futures markets and the cash markets. We obviously look at that very closely too. And I'd say as we move towards, expiration, all of that just gets heightened. Frequent conversations with CFT staff around these issues, just to ensure everything runs smoothly, because that convergence, whether it is a physically delivered contract or a cash settled, that's what matters most. That's the whole concept and key aspect of any product design.
Yeah, I'll just add, we have a slightly different product. Our settlement price relies on an auction on an actual Bitcoin exchange called Gemini. And so we monitor that market. We have extensive regulatory sharing information agreements with Gemini. So we see everybody and their behavior in both markets. And then we settle against an auction event. That our most recent settlement just occurred. And what we also do is we bound that settlement price by an index. So we also, not only do we have an auction, but we make sure that that auction is priced correctly based on an index similar to the CME. The settlement was, from our vantage point, quite successful on converting to that cash price.
The chair recognizes Glenn Mackey.
Thank you. Just a quick question with respect to the underlying markets underpinning the cryptocurrencies to some extent. So as you're thinking about new product and product development, where you have a sort of a distributed ledger type of currency or commodity that really has no regulatory construct, and that the protocols associated with the underlying commodity can be changed and modified in the form of like a hard fork, where you have Bitcoin and Bitcoin Cash going into essentially two underlying, different products, but yet you have a derivative contract on top of that. How do you think about that in the nature of differences between that and other commodities such as the natural gas and the power contracts, where the underlying market is regulated? You have different regulators looking at the physical markets themselves, and the construct can't be changed instantaneously like that if there's a split or a decision that is not good for part of the market participants.
We spent a great deal of time with the staff of the CFTC on that exact issue. They were very focused on that issue early in the process. That was a discussion. The fork policy, we all have fork policies around our products. How do we determine if there is a fork? The analogy used, I think the better analogy is the currency market and currency futures. The currency market is generally unregulated, and governments can change their currency at whim. So we deal with very similar issues with regard to the currency market today. But that said, we spent, and it's in our product specs, we did have to file fork policies and what we do with those fork policies. The key is also information sharing, getting information from the various crypto markets and having sharing agreements in place. And that's something that the CFTC staff asked for all of us to do.
I think of maybe a few different examples that might be relevant here. Certainly there is a lot of novel aspects of the virtual currency market, but there also are other contracts that have been introduced and also self-certified in past years. One of them that comes to mind is just the emissions market. To the point that Chris just made, emissions contracts, whether they are EUA or CER markets, are created by, a government mandate. And, so similar to hard fork, right? There's different vintages of those contracts that get created. And with legislation changing, with government position on those changing, we had to be in a position that our futures contracts could also adapt to those. similar to the EPA changing, the RBOB contract. For us, launching a product really is just the beginning. As we said earlier this morning, we constantly have to evolve and make sure that we are performing contract maintenance and that we've designed a contract that enables that type of flexibility to be introduced, and evolves as the underlying market evolves. And I think the other parallel with the emissions market, some may recall there were similar things where people were hacking into these registries and stealing credits. Again, it didn't make those markets go away. There were still very active futures markets that existed on them, and the obligation of the DCMs and the DCOs were to monitor the risk and ensure that we were meeting our regulatory requirements, which we were doing.
The chair recognizes Biswar Chatterjee.
Thank you for your remarks. What I'd like to point about is, we go back to the beginning and, we started the day discussing about how transparency into the self-certification process is really, key to this thing going smoothly and robustly. And I think Commissioner Benham, you mentioned about following process and what we do, especially also what we not do. And as I hear your remarks from, all three of you, it seems like you do have a process in place and you use that process. Chris, you mentioned about, contract participants coming to you and asking you to launch this contract. Dale, you mentioned about discussing this extensively with the clearing members and your risk committee and board. So to me, stepping back, it seems like a process is in place, the process was followed. But what I'm taken aback and I can't reconcile is, if this was so long in the works, discussed extensively with external stakeholders, parties, why was there this adverse reaction to the self-certification of this product? I mean, and this is probably another question to the rest of the MRAC as well, is like, what are we doing wrong? Or what can be done better to make sure that if a process is being followed, you guys are being transparent about it, there's extensive discussions with the regulators. I'm certainly don't want more regulatory oversight and, things that stamp out innovation. But where is the gap and how did this gap arise in your minds? Or, the other way to frame it is, if we did seek input from the participants, are the people representing those participants not representing the market because of the structure of what committees they're in and stuff like that?
I'll start. So I think the first gap that I noticed, first of all, I was surprised by the focus on self-certification. Having gone through the process, there was nothing that I felt self-certified about. We spent so much time working with the staff on this process, and I'm quite familiar with the SEC process, and they don't have this concept of self-certification, and it was identical. It was an identical until the very end and the nature of the filing. So I was surprised by the reaction to self-certification. I understood there was a great deal of focus on this Bitcoin topic. But one thing I did notice, and we've already heard it, the gap that I noticed the most was the volatility of Bitcoin, the actual volatility of Bitcoin, and the volatility that was reported in the press. That was the gap. And people believed what was reported in the press and treated it as though this was a toxic instrument. And that was not what our members were experienced in trading. So I think the area where, in retrospect, in looking at how we ran our process, a great deal of our conversation were with the liquidity providers and the end users, the market makers. We did talk to FCMs. We had extensive conversations with FCMs, but probably at the front end of the process, I would have flipped it to FCMs first and liquidity providers along the way. I think we were reliant on our liquidity providers to have that extensive conversation with their FCMs that they cleared through, and some of them didn't. And so that was probably the biggest problem with this. It was the press and the focus, as well as the misinformation around the actual volatility of the product.
Just to add on there, I mean, I think it's a fair question because I was seeing the disconnect that I'm having is when I saw folks saying, well, it seemed like it was rushed. And I was sitting there looking back at it, like we started talking this internally within our internal governance process in the first half of 17. And I brought this to our model risk working group, which is comprised of OCC, of the risk management, the model validation, the enterprise risk management, legal, compliance. We went through that process. Then it went to our risk committee starting in July, went back there in September. We've talked about this in a number of different forums. So that's when I felt rushed. I don't know if I've ever actually looked more at a new product than I did for this one. And then I'm seeing something that has rushed. I think there is something to be said, and maybe we need to make sure that we have the right folks on the forums that we reach out to. And maybe it's a talk with each of the different clearing members and whether they have the right folks there, whether everyone is aware of the forums that we reach out to make sure that they have proper participation. Maybe that's something that we could try to circle around and see if there's any gaps there.
Just to add to that, I think it was one, when we just looked at the actual financial markets, there was not a lot of volatility. Bitcoin was the one thing that had volatility, and to Chris's point, that is what was getting all the hype. And so I think in that, what that prompted is, different dialogues. And I think the challenge is that even within some of the end users that were asking us for this product, certainly at the FCMs, you couldn't be speaking with one voice in talking to a firm, because there would be difference of opinions even within the firm. And so I do think it's a good point of saying, making sure that we are talking across the firm to various aspects, not just the business, the operations, or the clearing risk folks, because even sometimes within those same groups they had different opinions. The other difference that I noticed is typically at launch, we are ready with all of our clearing members for a product launch. And in this particular case, we still don't have all of our clearing members that are offering this product. Many of them followed, different internal protocols because of the hype that their executives were seeing on the news and witnessing every day. And so that process is still playing itself out as well. But we were in a position to say we are not going to launch until we believe that we have enough participation from our firms as well as our end users. And we felt we got that towards launch. But I do think it's, certainly pays acute attention to who we're talking to and the diversity of opinions that need to be solicited.
We're just going to take 2 questions. The chair recognizes Michael Modlock.
Thank you. I just want to look beyond the self-certification into the roadmap of the product and where you move from cash settled into futures and listed derivatives, unlisted derivatives, trade life cycle events and post-trade and so on. Do you feel that there's an opportunity at an industry level to proactively explore some of the unintended consequences that might arise as these markets and products grow and evolve? And if so, how do you think that might look?
I think it's still to be determined. I think we've probably, as we've kind of talked about earlier today, not seen anything that has quite had this hype, has been so technology focused and maybe a bit abstract for many people to kind of get their heads around. But I think digitization is coming, and we all have to be prepared for it. We have to keep in mind, though, our jobs as exchanges and clearinghouses is to manage the risk of the derivative instruments, and our role is not to oversee the corresponding cash markets. But for us, watching those markets evolve, making sure we are in active dialogue. I think there's so many great opportunities because this is all people want to talk about. You can't go to any conference in basically any industry at this point in time that this is not the topic of conversation. So I think that will help it to evolve. We are taking the perspective of taking this very slow, we are, happy with being able to introduce the first product, but this is something that's going to be a gradual process. I don't think it's something that's going to come, fast and furious.
I'll just add that I think there's been more articles written than contracts traded thus far. Wish it was the other way around. Look, the cryptocurrency, it is an asset class. Let's be clear. Cryptocurrency is an asset class. There's over 1,400 crypto coins somewhere on the planet. We do see it expanding. We do see nation states moving into the cryptocurrency space and actual currencies being issued in crypto form. Some countries are piloting those cryptos today. I also envision a world where companies will be issuing coins. If I think about Apple and the number of dollars that I give to Apple because of my kids' downloads, I would like Apple to issue credits and coins back to me in form of Apple coins. If you think about American Express and the rewards program, that's actually a virtual currency that we can only transfer back to American Express. But I do envision a world where companies and countries will be issuing crypto coins. We need an underlying derivatives market to help support that to the extent they're freely traded. I also think that there will be an international, non-nation state active currency market in the crypto space. I don't know which one it will be. But I do see that there is large demand for that. It will ultimately get regulated. You're seeing regulation in Japan, where some of the exchanges have been registered, and at some point there'll be registration requirements here, or there'll be commercial needs for registration. So I do think it's an active asset class that we as derivative markets have to monitor, and we'll grow with it.
The chair recognizes Ed Pla.
Thank you. A few of you mentioned default management, and I'm just wondering, default management can potentially, depending on the circumstance, have two components, right? One could be the auction of a principal position or set of principal positions, and the second would be the porting of client positions if the default was for a clearing member, clearing for clients. So I guess the question is, how do you think about the adequacy of and diversity of clearing members for a given product or set of products? It's true that the default is that from the give-up agreements, the default is that when a product goes live, it is live. But it's probably also true that not 100% of your clearing members clear 100% of the products that are available on the various exchanges. How do you collectively or individually think about the adequacy and diversity of your clearing member set and whether they could support porting in a crisis?
So when we looked at the default management, let me just say that it's not only the clearing member firms that we're looking at, it's also the buy-side participants. Because if we are looking for auctioning off a book of a possible clearing member portfolio, we are looking for clearing members that could take on a portfolio. We're also looking at buy-side constituents who may have an interest in taking on a portfolio. So we engage in both of those. We test extensively with our clearing members on default management tests. When we were looking at this product, we were interested in having a broad set of both clearing members that were looking to clear, as well as buy-side constituents that would be able to take on a portfolio. So we know which ones have desks today, that if we did have to liquidate or auction off a portfolio with Bitcoin, we would know who to call, where to go to. So that was the most important point when we started off talking about default management. I'd say today we have a number of clearing members that are involved in the markets, looking at the OCC on the Bitcoin. It's not no longer a small segment. It's a number of clearing member firms, both the largest banks as well as retail focused. So there is a diverse selection of different member firms that are participating in this market. It's not concentrated into one or two firms.
We've had a similar situation to Dale. It has been a diverse set, and we are still continuing to see more clearing members come on and offer Bitcoin futures as this market has progressed. Some simply by the nature of the timing of the launches for CBOE and CME said, you know, December is not really good time for us. We still have some internal approvals to go through. Let's see how things play out. We will, you know, talk again in January, and that definitely is something that we are seeing in the diversity of members that are coming in. Obviously, the liquidation of that is key, and being able and default management procedures, testing of that's a key part of what we do for all of our contracts. I'd also say with just give ups, you know, we appreciate that give up transactions and those agreements are very broad in nature. However, you know, it is written in our rules that, you know, any clearing member can reject a trade from any other firm that they're not willing to accept. So that backstop has always been there. It is a part of our rules and applies to Bitcoin futures as well.
Well, that concludes panel number 3. Before we break, I'd like to turn it over to the chairman for closing remarks.
Thank you, Alicia. It's only my closing remarks. You still have another panel. But I apologize. I do have to go to another meeting and won't be able to attend that one. But I just wanted to say two things. We have two very proud traditions here at the CFTC. One is that our commissioners really embrace their roles as advisory committee sponsors. And two, that all of the commissioners actively participate in those meetings and stay as long as we're able and participate and actively listen. And I think today, as the first advisory committee meeting of 2018 and the first one of the new commission, I think you can see both of those traditions very much in effect. And since the tone in most organizations comes from the top, it then filters down. We've got a very good showing of commission staff here, and then most importantly, a great turnout from advisory committee members, great participation and great dialogue. So I thank all of you for this. I think this is one of the things that we do very well at the CFTC. We take good input, we listen, we reflect on that. Hopefully that comes out as good policy from the commission going forward. We will certainly take a lot from today and think about that and reflect that back in due course. So thank you all once again. I thank my fellow commissioners. I know they're looking forward to your last panel, and I'll look forward to hearing about it later on. Thank you all very much.
At this time, we'll take a 10-minute break, so please be back at 2:50. Could everyone please take their seats? I think everybody wants to hang out. Could everyone please take their seats? I need to be closer. I think there's still some wasser cake in the back. Please help yourself. The meeting is called back to order. And now we'll have the final panel of the day, regulatory and policy approach for novel products. And I'll turn it back over to Paul Archzel.
Thank you. So our panelists on this panel are Albert S. Kyle, Charles C. Smith Chair, Business of Finance, University of Maryland, Robert H. Smith School of Business, Edward Pla, Futures Industry Association, Managing Director, Head of Clearing and Execution for UBS, and Kari S. Larson, Counsel at Reed Smith. So with that, I'll ask each of you in turn to make a introductory statement, and then we'll have questions.
Okay, I will go first. I'm Pete Kyle. Thank you for inviting me to make comments about novel financial products. What I would like to do is take a step back in time to 1979 and 1980 when you had the Hunt brothers operating in the silver market. And the reason for thinking about that is that Bitcoin has many of the same aspects as silver. It's kind of money-like, it's kind of a store of value. It's very speculative, and it can be moved around in certain ways. So when silver futures started trading, I don't think anybody thought of them as posing a systemic risk to the economy. But when the Hunts cornered the market, silver became extremely volatile. Any risk management, any backward-looking historical risk management exercise that had been carried out became irrelevant. You had a day where you had 14 days in a row where there were limit up moves. I think there was one day towards the end when the price collapsed about 50% in one day. Even though people would not have thought it might happen, the Fed was the one that actually got involved, and by turning off credit to finance commodity speculation, made the Hunt silver corner unravel. The FCMs during this process discouraged their customers from trading silver futures, and many of them prevented their customers from trading silver futures. The Hunt brothers themselves used hidden ownership techniques. So this is one of the parallels with Bitcoin, is figuring out who owns it. But they hid the ownership of the people they were cooperating with. In those days, it was through Swiss secrecy laws that they were exploiting, and it took the CFTC many years to unravel actually who owned what and what had happened. It wasn't until several years later that the CFTC, through a lot of work, was able to figure it out. There was a very close connection between the cash market and the futures market. So if you focused on the manipulability purely of the futures contract, you would have been in trouble in 1979 and 1980 because the Hunt brothers cornered the entire silver market, and their activities in the cash market were very important. So there are a lot of things to remember about that episode. So a question here is what's novel about, I'm going to phrase it as what's novel about Bitcoin. And there's several differences that make the Bitcoin situation different from the situation of silver in the 1980s. The first is that Bitcoin is a cash-settled instrument, and so you have to pay careful attention to how the cash settlement process works. And what we heard earlier was that the CFTC does not like to see big aggressive trades taking place right at the end of trading during the settlement period. This could be big aggressive trades in the cash market or in the futures market, but most likely in the cash market. And I would like to point out that if you were the Hunt brothers, if you were cornering, let's say, Bitcoins, one technique that you might use is to set up some big short positions in the futures market through a company that was as thinly capitalized as possible, and then just let those short positions expire. So you do nothing when the contract cash settles. But by letting those contracts expire, you will actually put huge upward pressure on the prices, because the cash settlement process in effect buys your position in, even though you actually do nothing. So if a person with a large long position in the cash market that you don't observe pulls their Bitcoins off the exchanges, or has a separate entity with which those Bitcoins are owned, they can pull off a corner and appear not to be doing much of anything as they pull it off. Bitcoin is different in that it's even harder to figure out who ultimately owns the Bitcoins than it is to pierce through the Swiss secrecy laws. So I think this is something that should be kept in mind. And finally, Bitcoin is novel in that the fundamentals of supply and demand just kind of aren't there. It's in some sense a purely speculative type of commodity. It can be mimicked by others. And so it's very difficult to scientifically or apply economic principles to figure out what the fundamental value of Bitcoin is. And something like silver and most other commodities that we see, there's some kind of fundamentals to supply and demand that make them worth something or not worth something. So let me stop there.
I'd like to start by thanking Commissioner Benham, Chairman Giancarlo, and Commissioner Quintens for featuring this important topic in today's meeting with the Market Risk Advisory Committee. We appreciate it. My name is Ed Pla, and I'm the Global Co-Head of Execution and Clearing for UBS. And today I speak on behalf of the FCM clearing community of the FIA. Today's agenda explores the manner in which new and novel products are self-certified for listing by exchanges. The recent self-certification of Bitcoin futures in December have given this committee a prime example to discuss and consider. FIA strongly supports the self-certification process as enacted by the Commodity Futures Modernization Act, as well as the goals of responsible innovation and fair competition as set out in the CFTC's mission. With that responsible innovation in mind, self-certification provides exchanges with an important tool to come to market with new products after certifying that they have fulfilled their statutory responsibility as set out in the core principles of the Act and CFTC regulations. These core principles require exchanges to attest that important safeguards and requirements are in place before the launch of a product to ensure these contracts are indeed furthering responsible innovation and not endangering the marketplace. While Congress provided exchanges with the extraordinary power to self-certify its products, this self-policing authority comes with reciprocal responsibilities that exchanges act in the best interest of the marketplace. Today I'm representing the members of the clearing member community that play a pivotal role in the clearing of these products and the reduction of systemic risk in the markets. By margining and guaranteeing customer trades, contributing to the guarantee funds of clearinghouses, and committing to assessment obligations during clearinghouse shortfalls, clearing members are the foundation of the clearing system. One of the primary benefits of clearing is its socialization of risk through the clearing member default fund. This mutualization of risk protects the integrity of the financial system from contagion, but also requires clearinghouses and their clearing members to have strict requirements about the creditworthiness of the market participants and the risk management of the products that are cleared. This is due to the fact that clearing members are exposed to the risk of all market participants during a default, no matter whether the specific FCM is clearing the product or not. Clearing members cannot firewall themselves away from the risk of others in the clearing system. The sharing of fellow customer risk is a basic tenet of clearing that helps disperse and distribute risk. With several exchanges announcing last fall that they would launch Bitcoin products, there were various opinions within the industry about the riskiness of the products and how to properly manage the exposure. These were by no means standard product announcements. Even the CFTC and the NFA issued public statements regarding the potential volatility of the underlying cryptocurrency products. The FCM community believes that the launch of these new exchange-traded derivatives and cryptocurrencies would have benefited from more two-way dialogue among regulators, exchanges, clearinghouses, and the clearing firms who will be absorbing the risk of these instruments during a default. Unfortunately, the self-certification process, as discussed, is constrained in allowing for market input, and in this instance, there was only minimal and informal discussion with clearing members, depriving the process of critical information on certain key questions, such as whether a separate guarantee fund for these products was appropriate, or whether the exchanges should put additional capital in front of clearing member guarantee fund, whether the underlying cash markets are adequately regulated and liquid to support the settlement process for these contracts, and whether the products are properly margined. FIA applauds Chairman Giancarlo's announcement 2 weeks ago to improve the self-certification process by requiring exchanges to show that the industry was properly consulted before the launch of such cryptocurrency products. Specifically, exchanges will now be asked to disclose to the CFTC what steps they have taken in their capacity as SROs to gather and accommodate appropriate input from concerned parties, including trading firms and FCMs. This must be more than a check-the-box exercise and allow for a healthy and rigorous dialogue with market participants. Similar to the process for exchange rules, exchanges and CCP should be required to include in the self-certification submission the comments received by the industry and how they were addressed. This would add accountability to the self-certification process and provide the CFTC with assurances that the core principles are being met. We also believe that cryptocurrencies are not the only novel product class that may benefit from further marketplace engagement. We should not artificially limit the discussion to the topic du jour of Bitcoin. We believe the clearing members and other market participants should be consulted on any novel product that poses unique risk challenges to the markets and regulation. It's quite possible that had these enhancements been in place and the industry properly consulted, we would have ended up in the same place. However, the added transparency and process would have brought confidence and certainty that these products were adequately designed and risk managed to succeed. It's our understanding that the CFTC also plans to look at how exchange governance oversees the launch of these novel products. Just as regulatory oversight committees provide an independent voice on exchange boards regarding regulatory issues, it's equally important that exchange governance be constructed to ensure that risk issues are properly being debated and addressed. In conclusion, we do not believe it's the role of government to direct the business decisions of the markets it regulates. However, we commend the chairman and the commission for their willingness to reflect on the recent Bitcoin futures launch, evaluate lessons learned, and consider ways to make the existing self-certification process even better. I appreciate Chairman Benham and the advisory committee's willingness to discuss this important matter as part of the MREC agenda. Thank you.
Thank you, commissioners. My name is Kari Larson. I'm counsel with Reed Smith in the Commodities Group, and I'm co-head of the Global FinTech Practice Group. I focus my practice on innovative products and FinTech regulatory and transactional matters. I began my career in the CFTC's Chief Counsel's Office, the Enforcement Division, and then went on to become the General Counsel of an environmental futures exchange called Green Exchange. And following the acquisition of Green Exchange by CME Group, went on to be the General Counsel of LedgerX, a CEF and DCO that offers swaps and clears swaps and options on digital currencies. I now advise numerous clients on over-the-counter and exchange-traded cryptocurrency products and represent a number of blockchain-based or crypto-related platforms. I've spent a significant portion of my career, both as an outside lawyer and as an inside counsel, evaluating novel products, examining how to trade them, how to properly effect and document transactions, how to effect physical delivery, how to perfect a security interest, and other novel issues. In the early 2000s, I helped clients develop telecom and weather derivative products, and I particularly specialized in environmental commodities, representing ISDA in drafting the U.S. emissions annex and assisting clients in the U.S. and EU carbon markets and renewable energy markets. Novel products can present novel challenges, but in my experience, there are more similarities in how these products progress and work within the commodities markets than there are differences. They start to operate in small, illiquid markets with fewer players. They almost always begin in a physical environment with industry-specific traders that may be unfamiliar with derivatives markets on the whole. The OTC market is extremely important in the beginning stages of these products because it permits new transaction types to emerge. Over time, they become sufficiently standardized, ideally to support migration to an exchange. Often, it can take an exchange, as discussed in some detail in our prior panel, 6 months to a year or more to bring a product to market. There is significant research and analysis involved, internal and external legal and consultant review, new technology and testing, marketing and sales, and risk analysis. For anything other than a simple change or addition to an existing contract, it includes meetings with CFTC staff. For novel products, the challenge is even greater as it also requires market education, additional CFTC meetings, and connecting new participants. However, my experience has shown me at heart that these products, the principle-based regulation allows enough flexibility to encompass and address novel products. They do operate similarly. Crypto, for example, may have some unique characteristics, as has been discussed today, but it has progressed through the trading stages very swiftly in comparison to some other previous unique products. But it trades and operates like any other commodity. It was created like the sulfur dioxide allowances were created by legislation and regulation. It can be volatile, as can be rhodium and palladium. Some crypto, like Bitcoin, operates as a store of value or an investment, not unlike gold. And like emission allowances, some tokens provide an intangible right to a good or a service. Physical delivery is accomplished on a digital ledger, similar to other exempt commodities like carbon credits or RECs. It wasn't that long ago that the Commission wasn't certain about the environmental products and where emissions fit into the existing regime. Along with the Dodd-Frank regulatory proposals, the CFTC included a number of questions to the market that indicated staff was considering whether emission allowances should be considered swaps. Comments overwhelmingly disagreed with that proposal and discussed how allowances can be consumed, used for compliance, used to be good actors, and were more than just a financial value transfer. The final rules agreed, stating the intangible nature of environmental or other commodities does not disqualify contracts based on such commodities from the forward exclusion from the swap definition. Cryptocurrencies and assets have the same intangible nature, as will future products to come that we have yet to imagine, but still can be handily addressed by principle-based regulations. I also suggest that crypto's characteristics may soon lend themselves to many more products. We continue our march towards digitization. Cash and FX are digital markets themselves. Cybersecurity is one of the most important risk measures of our age. The technology advances likely will have more effect on policy and may require some rule revision as we progress, as exchanges move to distributed systems and clearing may be accomplished via smart contract. I look forward to the challenges that these new technologies and novel products will bring, and I look forward to our discussion.
Thank you. So I think a few questions arise at this point. One is the current process, the self-certification process, appropriate for new and novel contracts?
As I said, I think that how products currently come to market, for all products, unless it is a simple month addition, goes through a process even with the self-certification. It involves meetings with members, it involves meeting with participants, and it involves meetings with staff. There is a process in place. I think that most people are comfortable with that process, but that's not to say that there can't be improvements to that process.
I'd say, it's a function of the concept of novelty. I don't think novelty is binary. I think it's a continuum. And so the question is, implicitly, at the most novel, complex end of that spectrum, is the process adequate? And so I think the question is, maybe the answer is, should there be more regulatory engagement? Should there be the potential for a circuit breaker in that that self-certification process to ensure that the views and the considerations brought by a variety of stakeholders, trading firms, clearing members, regulators, end users, are all taken into account in product design and risk management?
So I think that leads, the next question is, how do you define what's novel and complex, or what's novel? And where along that continuum does the more in-depth process kick in? I think in retrospect, looking at Bitcoin, everyone can agree, well, that's a novel instrument. But the next one coming down the line, how would you identify what's a novel instrument which should be subject to additional or heightened review?
You know it when you see it. Look, I think there are probably a few factors that we could consider, and if you start to say that factor exists with this product, then maybe you're at the more novel or complex end of the spectrum. So a few that come to mind would be the product has limited price history. So even though we're going to do lots of statistical analysis, even a couple of years of price history might be pretty meaningless in the history of financial markets. Maybe historical prices are volatile and or there are price discontinuities. So if you have a combination of volatility and gap moves, so to speak, maybe that's an indication of poor liquidity. So again, you've got limited price history. The price history you have could be volatile and price discontinuous, so suggesting the possibility of lack of liquidity. Maybe the product is one that we think has the potential to introduce meaningful new risk to the clearing member community. Maybe not at the outset, because as you said correctly, most products start slow and then grow. But if it has the potential to materially impact that mutualized risk pool, have we considered the implications and the safeguards? Another might be settlement operational risks. So is there anything unique about the settlement process that introduces dependencies, operational risks that could become problematic? And does the product dominantly appeal to a niche client segment?
Appeal to what?
A niche client segment. So if that's true, does that mean that there is going to be a very small subset of clearers who are willing and able to clear the product? And then how might that affect the ability to port client positions in that product in a crisis? I don't think that's an exhaustive list. It's meant to maybe kick off discussion, but I think those are probably factors to consider.
I agree. I think it's primarily important that it not be because it's a volatile product. A lot of products are volatile, and that is part of why there are futures contracts offered on these products. There are, to look at, as they mentioned earlier, to look at the default risks involved, and if it operates differently or the calculations would need to be significantly different and it would be a unique bucket, I think that's something that would be worth consideration.
I think from the CFTC's perspective, something important to think about is whether the staff of the CFTC would have the capability to sort out some kind of mess or scandal that wound up being dumped into the laps of the CFTC as a result of something going wrong with a new product. So if it's something like a different agricultural product or a different metal, something that the CFTC is kind of used to dealing with, it may not be that novel. But if it's something like a cryptocurrency and the CFTC were asked to sort out some kind of bankruptcies or financial disaster that occurred by doing some forensic research, would there be any expertise at all within the organization to actually do it? And I'm guessing the same thing I'm saying about the CFTC applies to the exchange itself, that it would be novel from an exchange's perspective if the exchange did not have the ability to work its way through problems that might occur in its own contract simply because of lack of familiarity and lack of expertise. I want to take a little bit of issue with something that was said earlier, and this is the idea of running new financial products by, let's say, the existing people in industry who might be affected by those products. I think if that had happened completely in the 1970s, we would never have gotten financial futures. I think that the finance industry was threatened by financial futures and didn't want it. And it kind of got it anyway, and it was a good idea that came about in the 1970s precisely because the futures exchanges were kind of going out and doing their own thing without a lot of support from the dealer community.
So that raises an excellent question and an interesting problem, and that's the concern of stakeholders wanting to be involved in the launch of new products and the new products potentially being disruptive to the existing industry. So how does one balance those two somewhat competing aspects?
So let's go back to onion futures. I think there was a law that onion futures were not allowed in the U.S. And I think if you look closely at it, you'll find the reason was that the dealer community didn't want the transparency and the ability of smaller participants to kind of see what was going on in the market. So one of the advantages of futures markets is that they are transparent and easily available for all to see what's going on. And what that does is it levels the playing field. And leveling the playing field is bad for the people who have the playing field tilted to their advantage, and is good for the people who don't have the playing field tilted to their advantage. So the part of the innovative nature of futures markets is that it may, the innovation may adversely affect entrenched interests that want to protect what they have.
It is a balance because in an exchange, essentially what you're talking about is a commercial product from an exchange. So it's proprietary, and there's going to be delicate aspects to the product and the calculations and the analyses. But part of that is interacting with members and with users and figuring out demand and figuring out how to best craft the product that will have the best appeal. But those are commercial matters, and which is different from the risk analyses. That and the clearinghouse working with the member is really going to the risk assessment. So I think there's two separate buckets that have to be kept in mind. Some of it is to establish whether there will be activity, and some of it is to establish the risk parameters. And I think it's very hard to dictate that. I think that's something that the exchange has to evaluate, and as part of the process, part of the discussion, has to discuss with staff and see where there's comfort level or not. It's hard to put metrics on it.
I think the client clearing service is a fee-based market access service. And the way, I think most firms would look at new products is they prioritize based on client demand. And so, it's probably fair to say that as new products are introduced, if an exchange or a clearinghouse is detecting demand, there's probably reciprocal demand being detected by clearing members, trading firms who take the other sides of those trades.
Professor Kyle, you discussed silver as having some parallels to Bitcoin, but the example is a little bit different in that silver had been trading for many years and was an accepted futures contract without people really thinking of it as being particularly problematic. How does that example correspond to Bitcoin, where it's a newly introduced contract? And how does the example that you could have potential for manipulation based upon a parallel analysis, how does that affect the process one would use to introduce a new contract?
So I think that there's some parallels. There are some things that make Bitcoin novel compared to silver. And one of the main differences is that silver was not only physically delivered, but some of the delivery facilities were right there at the exchanges, where the exchanges could keep an eye on what was going on with regard to delivery on a daily basis, because it was essentially part of their business. And Bitcoin is quite different in that the ultimate cash market for Bitcoin is quite separated from the exchanges. And because of that separation, I think that's why you have the cash settlement rather than the physical delivery. That is, the exchanges would like for there to be a seamless relationship between the cash market and the futures market, but there kind of intrinsically isn't. So you use this cash settlement mechanism to try to build a bridge between the two. And that cash settlement mechanism creates things that are novel relative to silver, but of course not novel relative to other futures contracts, which are also cash settled. But I think that many of the issues that are related to cash settlement have not been sorted out from a regulatory perspective, even within the CFTC or even within the sort of legal way in which they're regulated, because the ability to corner or squeeze or otherwise manipulate a contract is not solved by cash settlement in any way. Many people believe that somehow cash settlement makes these problems smaller or even make them go away. It doesn't make them smaller, it doesn't make them go away. The problems of manipulation in the forms of corners and squeezes are exactly the same with and without cash settlement.
The chair recognizes Sebastian Cohen.
Thank you. I'm here representing a group of proprietary trading firms, so I figured it'd be a good idea to also give a perspective on what we do with regards to new products that enter the marketplace. Typically, when exchanges come up with ideas to bring new products to the marketplace, I think they do indeed try to reach out as much as possible to the stakeholder group I think Jerry alluded to earlier on. They're looking for firms like ours to provide liquidity in new futures, new options products that are out there. So they typically ask us about a lot of different things. What do we think about the product specs? What do we think about contract size? All those kinds of things. And in return, we ask questions back and we say, okay, well, what kind of interest is there out there? What kind of end users are there that are interested in trading these kinds of products? How are you going to measure risks, things like that? Are there clearing firms out there that are willing to clear these kinds of products? So I think we're looking at this problem of new products through the same eyes probably as exchanges. We're looking for a long-term success for a product. We're going to be able to trade these products in the long term, provide liquidity, which is in the end our business model. So I think our alignments are exactly the same as an exchange that's looking to create a long-term sustainable product. Not only on the commercial side, I think you split the product between the risk side and the commercial aspects. I think they're looking for that from a risk perspective too, and I would argue the same goes for firms like us, which is why, from my perspective, the self-certification still makes a lot of sense. Thank you.
The chair recognizes Jerry Jeske.
So the question of novel keeps coming up, and I certainly agree with what Sebastian was just saying, but you talk about how something's novel. I don't think you're ever going to be able to define what's novel. Just like it's very, very difficult to define who are the constituents, who are those that have some skin in the game when it comes to a new product. It's just not exclusive to the FCM community. It's just not exclusive to large institutions. Those people that manage risk, whether they're in agriculture, if they're in energy, if they're in various different types of products, all have the potential to be stakeholders. So it would be great if the commission and exchange staffs had endless time to develop these products and so forth, but they don't. Time does matter. So to the extent you're going to engage those that are true stakeholders, I think it's somewhat of a endless process. And certainly I think one can learn, as I mentioned earlier, from the electricity marketplace. The RTOs and the ISOs and the stakeholder process is a very tenuous, strained process. So what has been done here and continues to be done, I think, is something to be embraced, not to be criticized. So just because we have something which one may define as novel, I think I've heard a couple people in this room in side conversations say, don't throw the baby out with the bathwater. Self-certification is not broken. So whether it's novel, whether there's enough constituents involved in the process, I think is an endless debate. And probably there's no resolution to that question.
The chair recognizes Marcus Stanley.
Thank you. This might have been a question that was better placed to CFTC staff in the morning, but I'll place it to this group anyway. The Securities and Exchange Commission has taken a very different kind of perspective and approach from the CFTC in terms of its approval or its perspective toward Bitcoin products. It's issued quite a number of warnings. It has refused to approve what could be classed as Bitcoin derivatives products like exchange-traded products, exchange-traded funds. There are several reasons for that, including, I think, the attitude of Chair Clayton, the chair of the SEC, as opposed to the attitude of the governance of the CFTC, and also statutory differences and distinctions. And one of those statutory differences is that in the Exchange Act, there is a requirement that the rules of an exchange be designed to prevent fraudulent and manipulative acts and practices and to protect investors in the public interest. So there is kind of a general public interest provision in there, and the commission interpreted that to say that that any exchange-traded product had to have surveillance transparency into the underlying trading markets, the trading markets for the underlying, and the trading markets for the underlying had to be regulated. So I'm wondering if this group feels that there is something of value in that public interest provision, for that sort of general public interest provision as regards exchange rules, and whether those the position the SEC took in terms of needing surveillance into the underlying and having regulated underlying markets was a reasonable and positive one.
Well, I think there's a couple things that are different with the SEC in addition to the language that you mentioned. The SEC is also, it's true at the ETF, and their reasons are shifting slightly on that, but initially it was that there was no regulated markets, and now I think it goes more to Ed's point that they want more time for price discovery and more time for watching the products before. So they've asked those that have submitted the ETF request to withdraw until there's more time to evaluate. But they have not said that they have any jurisdiction over Bitcoin or any cryptocurrencies. They've likened Bitcoin and cryptocurrencies akin to money, as opposed to the crypto assets, where a lot of their warning and investor warnings go to the token sales that are going on, and right now they're focused significantly on potential fraud in those markets. So I think that there's a few different buckets that the SEC is looking through, and the prism that they're viewing this through is just a very different view from the CFTC and the commodities world, where starting with CoinFlip in 2015, establishing that cryptocurrencies are commodities, fit the definition in the Commodity Exchange Act, and as this market grows, I would say that would still be the perspective that the crypto tokens and cryptocurrencies are commodities, and how they trade and how derivatives products are created off of them is a very different process. And I think that with the core principles that are addressed for the futures exchanges and the CEFs has extensive protections within that as they stand.
I think that as soon as you start trading a futures contract on some underlying asset, no matter how little regulation the underlying asset previously had, you automatically get a little bit of regulation, because the problem of manipulation that might occur in the futures contract, when it does occur, it's also probably occurring simultaneously in the underlying, and the CFTC is going to start inquiring about the underlying and asking questions and collecting information and imposing various legal obligations on the exchanges to go along with the CFTC's learning process. So part of undoing the novelty of a novel situation is the CFTC learning, but part of that learning is effectively regulation coming into a market that did not used to be regulated. So I think the big question here is whether the right way to do it is to be so cautious getting into it that you wait a long time and don't start anything until you fully understand it. Or alternatively, to experiment with ideas that may not be very good in markets that may not work very well. And then if they fail, so what? Maybe they just fail on a very small scale. I know I've brought up these past examples, but let me bring up another one. I believe the first interest rate futures contract was the Ginnie Mae CDR contract from the 1970s. I believe that was a totally flawed contract. The idea of futures on mortgage-backed securities was a fabulously good idea, but the contract itself was terrible. It was nevertheless approved. It nevertheless traded for a number of years. Eventually, the flaws became apparent, and there was a migration out of that one, into another one, and then that one maybe didn't work so well either. And eventually, the Treasury bond futures contract and now Treasury note futures contracts have become the center for determining interest rates in the U.S. So it started out with a process that you might say approved some novel contracts that didn't work very well, maybe because they didn't think through it enough. but the end result was, I think, quite good. The other side of the coin, which goes to Marcus's question about the SEC, is single stock futures. I think single stock futures are a great idea. It was a great idea in the 1970s when they were proposed. So what happened for the next 20 years with respect to single stock futures? The answer is not very much. And the reason I think not very much happened is that the SEC didn't want to do anything unless it was perfect. And nothing's perfect, so nothing got done. And that was kind of a bad outcome. So something probably in between is a good idea, where there's some thought that goes into the process of designing a futures contract, but the knowledge that even when it's first approved, it's not perfect, but it's a learning process that you're getting into is the right way to think about it.
We're going to take one more question, and the chair recognizes Kathleen Cronin.
Thank you. So there's been a lot of discussion of novel and complex, and I think what's important to reiterate from our perspective is that the asset class, the underlying asset class, is a new asset class, but our product itself is very much in line with other products that we've done on indices. And a number of the factors that Mr. Pla mentioned with respect to what constitutes a novel product, I think, volatility doesn't make something novel. It's something to be managed, and it feeds into how we determine what our risk processes are going to be. Bitcoin futures our index has a year history, and Bitcoin itself has a much longer price history than that. And in terms of impact on the risk pool, again, we trade and clear products that are volatile and that create certain risks outside of Bitcoin. And I think Julie mentioned the emerging currencies, which is a good example. And we do risk manage for those, and it doesn't present a unique risk to the mutualized risk pool. And again, we did have over 200 meetings with customers, clearing members, and others during this process. And you're not going to reach consensus as to what is a good product to bring to market or not bring to market. And ultimately, it's up to the exchange to self-certify those products and ensure that they're in compliance with the core principles. And our clearing members can choose to clear those products or not. And frankly, if no one chooses to clear the products, then it's not going to be successful. So it's not in our best interest to bring it forward.
Thank you. So I think we've had a pretty productive day and a very good conversation. To wrap up, I'll pose two questions that I think everybody will have an opportunity to answer as we go around the table. Just lift your name tag up if you'd like to respond. The questions are, one, what's an optimal process for SRO introduction of new products, and specifically novel products? And number two, what's an optimal process for CFTC oversight of new products, both pre and post launch?
I'm happy to start. I think I'll reiterate what I said earlier, and I think many of us have said it as a disclaimer at the beginning of all their comments. I think certainly FIA believes that the self-certification process is valuable. It's valuable to our markets, and it encourages innovation and has a history of encouraging innovation. And yet I think the comments made by Chairman Giancarlo a couple of weeks ago at the ABA conference, to me indicates a willingness to say, let's reflect on what we've learned. Is there something about this particular product and set of circumstances that wasn't envisioned, and is there an adjustment we should make? And I think the recommendations that he's already proposed, which is that DCMs and CEFs should be asked to disclose the steps they've taken together and accommodate input from concerned parties, extremely sensible, and make that available so that people understand, how those comments and that feedback is incorporated into the product design and the product launch. So I don't think that's throwing the baby out with the bathwater by any means. I think that's taking a very good and valuable set of regulations and finding ways to make them even better and more fit for purpose as we continue to, find new product types that are valid for listing.
The chair recognizes Marnie Rosenberg.
Thank you. I thought Biz asked a really good question on a prior panel about why has there been so much controversy over this launch. if the exchanges and the clearinghouses that were on the panel sought input. So clearly, I think there is a need for a member consultation process that happens on the front end, which I can say didn't universally happen in this case. And given that members ultimately do provide a significant amount of financial resources that is mutualized, there is the vested interest of the clearing member community from a risk perspective to be engaged and provide input. We at JP Morgan invest a lot of resources in due diligence of margin models and stress testing, and we do spend a lot of time giving that feedback back to clearinghouses. So we do hope that that is considered in this process going forward.
The chair recognizes Dale Michaels.
I think the recommendation as far as having DCMs prove that there's been some type of reach out is a valid path, one that certainly we want to see happen, at least from the clearinghouse perspective. We do have venues to reach out to our clearing member firms to solicit feedback, and not just the clearing member firms, but the buy-side constituents as well. That's important to us. I said I was a little surprised at the disconnect, and I think that's a lesson to learn. Make sure that the right folks from each of the firms are on the panel, so that feedback is getting back to the proper folks at each of the firms, because these are important feedback forums. Because, as I mentioned, we do take this feedback seriously, and this feedback goes to our risk committee. So we want to get that opinion. We want to know what concerns there are out there, purely from a risk management perspective. I think was mentioned on this panel, we certainly don't want to get into the competitive issues. I mean, we think that the self-certification process has led to a great deal of innovation in this industry. You see it, the products that have been launched because of the CFTC oversight has been tremendous. I mean, you talk about Ginnie Mae CDR leading to treasury bonds, leading to interest rate futures, leading to the energy futures and everything else. We want to continue that path, but we do need to make sure that the risk management considerations, which are very important to us, very important to our clearing member firms and the buy-side constituents, we take that seriously and want to make sure that continues to happen as well.
The chair recognizes Kathleen Cronin.
I'll be short because I think I've reiterated my views before. I think the self-certification process as it currently exists works well. I think we had a robust dialogue with the commission staff before we launched this product, as well as with customers. We took into account feedback in making our decisions as to how to design the product, and we continue to remain open to feedback from our clearing members with respect to how we are risk managing the process. I think none of our clearing members are shy about providing us with feedback, and so we are happy to engage in discussions on that.
I would just one point I would make on the notion of risk committees. I think that's a valid group of people to consult. I'm not sure that's a comprehensive group of people to consult. Their composition could be distinct. They're not necessarily a representative sample of all constituents, including trading firms and clearing firms. So I think that's a necessary but not sufficient condition. If we decide that a product is sufficiently novel that kind of market outreach is a desirable component of the process.
The chair recognizes Marcus Stanley.
I think from a public interest perspective, we always get concerned when clearing members publicly raise an issue about risk management at the clearinghouses that they are members of, because it's hard to see what the incentive would be to do that if there's not actually a problem. So even though we don't always agree with clearing members on all their positions on this one in particular, raising an issue about risk management, we consider that a red flag, and the fact that it has come up in this case, I think, does point to issues for concern in self-certification.
The chair recognizes Richard Miller.
prevent the feedback. To your second question, Paul, about how the CFTC surveils or risk manages on an ongoing basis, I had a thought that came to mind when I was reading Professor Kyle's resume, and it cast we have something in common that goes back to the 1987 crash. And at that time, the poster child of the 87 crash were stock index futures because of the product that was popularized in the financial markets called portfolio insurance. And portfolio insurance assumed that you'd be able to execute stock index futures into a declining market. And it was sold as a risk management tool to financial end users. But the overhang of the potential use of portfolio insurance would not have been reflected in open interest and would not have been reflected in the markets, but was a product that was hanging outside the markets. You wouldn't have been able to see that in the futures markets until it actually happened. So the cautionary tale you take away from that is that ongoing surveillance of the marketplace has to take into account not just what you see in the marketplace, but sort of the anecdotal evidence of what's out there that's being packaged up in financial products that might be sold on an ongoing basis, popularized. And it seems to me just intuitively that the mystery around Bitcoin has the same kind of magical charm that portfolio insurance had and stock index futures had back in the 1980s. It might become an attractive financial product to be packaged up, and you might not, as a means of hedging somehow, that you may not see as a product in the market because it's an overhang. So my cautionary remark is, the CFTC needs to be aware of what's out there that may not be reflected actually in the open interest and in the, what's actually in the clearing markets at the time.
The chair recognizes Ms. Worp Chatterjee.
As per the discussions going on, I think comment from Jerry was very valid that, we shouldn't try to change the self-certification process by labeling products good or bad or novel or plain vanilla. I mean, in the end, the entire robustness of the self-certification process relies on transparency, and whether that's transparency between the exchanges listing the product with their trading partners, with the clearinghouses that are going to clear it, with their FCMs, or the clients, that would be indirectly clearing it, and sharing that transparency with the commission. I think that's where the robustness of the self-certification process really falls. And, a number of points have been made. I think Dale just touched on it, making sure, if you're consulting people, it is the appropriate, constituency of consulting. One of the panelists mentioned in the previous panel the challenges of reaching out to a firm and then making sure you're getting a consistent view, whereas, the trading arm versus the clearing arm versus the operational arm may give you, different views. And I think, Rana, I think you alluded to the point that, the broad FCMs and their readiness to clear should also be a key factor into whether, the product, will face, a much more smoother transition. So I think it's a variety of these things, and I don't think we should just be limiting this activity to novel products.
Oh, we have one more.
Just one quick comment.
Glenn.
From an end user's perspective, if the banks do have concerns with the process as far as self-certification in the product, they have the ability to charge their customers additional margin or limit positions as well, and that's from a risk management standpoint, which we see as an end user. So, and in particular where there are potentially products that different parts of the bank may be competing on a bilateral basis, I'd caution that, to some extent, where there's market participation for clearing, it makes sense to have some discussion around the risk management aspect. But the commercial aspects of it, as Jerry pointed out, are really specific and where end users are actually looking for unique products to potentially hedge risks that they can't lay off in traditional ways through some of the financial institutions and other market participants that warehouse the risk on behalf of the end users. Thank you.
Well, thank you, Paul, for moderating today's panels. And it's now time for closing remarks. So we'll start with Commissioner Quintens.
Thank you very much, Alicia. Thank you for all of your hard work for today's hearing. Commissioner Benham, thank you for your leadership of this group. Paul, thank you for your steady hand guiding the conversation, and members of the advisory committee, thank you all for your feedback. I learned a lot from each of your comments and questions. To all of the presenters, thank you for the work that you put in to bringing really interesting thoughts to us, to the staff. I wanted to bring up something that Commissioner Benham raised in his opening comments, which is that novelty is a fleeting concept, and I think, Ed, it goes back to what you said: is novelty is a continuum, and we're seeing in the market now, we're seeing digital commodities being created on a daily basis. So novelty, to some extent, is actually becoming somewhat mundane. And while it may be tempting for all of us to want to draw bright lines and create tests around that, I think it's also important to remember how well this agency has been served and how well the markets have been served through principles-based regulation. And just lastly, I wanted to compliment the agency staff, not only those that gave very robust presentations today, but also all of our staff that work hard on a daily basis to ensure that market participants are following the CEA and our commission regulations. So thank you all for participating today. Really appreciate it.
Thank you, Commissioner Quintens. Commissioner Benham?
Thanks, Alicia. I want to echo Commissioner Quintens' comment about CFTC staff. They do a fantastic job day in and day out, and I think we at the Commission owe them pretty much everything that comes out of this building, and it's really fantastic work. Of course, for those staff involved today on the first two panels, thank you again for your work and your contributions. A lot to be taken away from today. I appreciate everyone's time and effort. A lot of different conversations from different angles. Obviously, self-certification is a big issue and one that is sort of the headliner of the discussion. For me personally, as I said in my opening comments, self-certification is over 15 years old. It's worked well. It continues to work well, and I think it will work well in the future. It serves the market well. It serves the CFTC well, and it promotes innovation, which I think should be our number one priority. So I hope that message is clear, and we'll continue to support the self-certification process. That said, there's always room for improvement, and I think from both sides, the market participant side, clearly the processes that are in place when new products are launched are very well established, and I think everyone clearly demonstrated that the processes are in place, and people are constantly thinking about these, because I think, as I've said this many times, the incentives certainly with the market participants to put out good products that last and that have utility in the marketplace for both the exchanges, the clearing members, and of course the end users. From the CFTC side, the first two panels, I think the individuals demonstrated what the Commission does every day to ensure that we are fulfilling our responsibilities both under the core principles, but the Act and the regulations as well. And I applaud them for all the work, and I think the processes there are as well very good. That said, regardless of this question about novel or not, we constantly need to be thinking about new products that are coming to market. And as they do come to market, forums like this, I personally feel a lot better this afternoon than I did even this morning, let alone a week ago or a month or two ago. And that's because we were able to have this very transparent and honest conversation about what's been going on with respect to cryptos and how it affects the marketplace. So I hope we can continue to do this, because I think this is going to make, all of us at this table, the regulators, the market participants, and the general public feel pretty good about what we do on a daily basis. And that said, like I said earlier, there's always room for improvement, and I think these venues serve as an opportunity to think about hard questions and better solutions in the future. So with that, a quick thanks to Paul Archizel for your time. Paul was a great moderator. and a gentleman who has a lot of history in this building and understands these issues very well. Alicia, thank you again for really doing a fantastic job for the past 2 months, and I know you're looking forward to future MRAC meetings, not soon. Thanks to Commissioner Quintens for participating all day and adding very insightful thoughts and comments as always. And of course to the chairman for attending while he could. Finally, to this committee, as I said earlier, this will likely be the last meeting of this committee. Alicia will be taking steps in the next couple of weeks or months to issue a very broad invitation to the general public for the next MRAC. So we welcome your participation, or at least your interest to participate in the future. That said, we'll be taking a fresh look and thinking about ideas and issues to cover in 2018, 2019, and the years ahead. So thanks. I know Commissioner Bowen was very proud of this committee and the work it did, and you all deserve a big thanks for your sacrifice and the time that you've given to it. So thank you. And with that, I will turn it over to Alicia to wrap up.
Thank you, Commissioner Benham. Again, thanks to the members of the MRAC for a very engaging discussion today, and thank you to our speakers for great presentations. Okay, I want to thank everyone for attending the first MRAC of 2018, and this meeting is adjourned.